Okay, good afternoon, everyone. So today we are going to do the chapters of financial markets and products. Now, those who joined a bit late, so we had this initial discussion that we are dividing the class into 2 or 3 parts because we will not have all the chapters together in one go. That consumes a lot of time, and it was a little bit inconvenient for some candidates. Also, today we are going to cover 6 topics of FMP, FMP 4, then FMP 7. 4 is introduction to derivatives, then we'll have futures markets, then we'll have valuation of futures, foreign exchange markets, and then some properties of interest rates. Okay, so these are and foreign exchange. So these are chapters we're going to deal with, and the remaining topics we'll cover next Saturday. And if possible, if we get some extra time, then maybe in one of the weekdays after office hours, we can have another class. Okay, so that will distribute the topics evenly into 2 or 3 parts. Now, as I said earlier, also in QTA also, and in today's class also, I'm saying the same thing that this is a crash course, a kind of a revision session where not everything is going to be discussed in great detail, but we are going to do a very quick revision of the topics. And from the exam point of view, whatever is important, we will make sure that we don't miss to cover those topics, right? So let's start with introduction to derivatives. So what are derivatives? Derivatives are contracts whose values they depend on or derive from the values of one or more financial variables. Those financial variables can be equity prices, those financial variables can be exchange rates, those financial variables can be interest rates. Okay, in fact, as of now we are considering only financial variables, but there are many other underlying variables. Even weather can be one of the variables, but in the FRM curriculum we are restricted to financial variables only. Now each of these variables on which the derivatives value is dependent on, it is known as the underlying. They are categorized into linear as well as non-linear products. They trade in exchanges as well as in the over-the-counter market. Now, what is an exchange? An exchange is a market where investors they trade standardized contracts which are defined by the exchange itself. And what are over-the-counter markets? Over-the-counter markets are markets where participants contact each other directly to trade, or maybe by using a broker as an intermediary. So this is a comparison of the size of the two markets, and you can see how the size of the market in terms of the value of the underlying. Okay, so this is measured in terms of the value of the underlying assets. That's why you can see it's in hundreds of trillions of dollars. Okay, not the actual value of the derivatives, but the value of the underlying, because value of the underlying is much more. So you can see that very clearly the OTC market is having a much higher size as compared to exchange traded market throughout these last 14-15 years, right? But you can see that there was a dip. There was a dip over here also and over here also in the OTC markets. And in fact, there was a downtrend. If you see, starting from June 2007, 2008, you can see there was a downtrend up till probably 2017, 18. And again, the markets, OTC markets have started to pick up. So obviously, the biggest reason for this was the great financial crisis, where a lot of regulations. I mean, first the markets failed, and there were systemic risks which were not dealt with properly, which led to this big financial crisis. And after that, there were a lot of regulations in the OTC markets also. And the popularity of the OTC markets, you can see, started to diminish a bit. But still, in spite of that, it was far ahead of the value of the underlying in the exchange traded markets. Now, what is a forward contract? This forward contract is an over-the-counter contract where one party agrees to buy an asset for a predetermined price at a future time, and the other party agrees to sell the asset for the predetermined price at the future time. So this predetermined price, what we call it? We can call it as the exercise price, sometimes the strike price, sometimes the delivery price. Okay, so all these things can be, these terms can be used parallelly, but they imply the same meaning, predetermined price on for which the delivery will take place. This future date is known as the expiration date. So this is a commitment and agreement between two parties. Both parties have to honor the agreement. Whatever is the price of the underlying later, both parties have to honor the agreement. So let's take an example, and let's also understand why these forward contracts can be used. So what we are doing is we are trying to merge certain examples, okay, so that you can understand the use also of these forward contracts and how they can be executed. Okay, very quickly we'll do it. So let's say there are two parties. One is party A is receiving foreign currency and B is paying foreign currency. Okay, so what is the concern for A? Tell me, in terms of currency, what is the concern for A and what is the concern for B? What do you think? The concern. Forget forward right now. If I am going to receive foreign currency, maybe after some time, okay, in say 1 month, B is going to pay foreign currency in 1 month. What is the concern for it? Yes, exactly. The exchange rate is the concern for both A as well as B. So for A, the concern is that based on the exchange rate, since A is receiving foreign currency, the concern is that the foreign currency value will fall. Okay, so that will make, so for example, if we have say Indian company, let's say TCS. Okay, TCS is exporting a lot of IT services to one of the countries in Europe. Okay, and TCS is going to receive the payments in euros. So the biggest concern for TCS is that the value of euro will fall, because finally TCS is an Indian company, it has to convert everything to Indian rupee. Okay, so the concern for TCS is that the euro will fall and it might actually lose some of its profits just because of this fall in foreign currency. So that's the concern for A. And the concern for B is that the foreign currency will rise, because B has to pay foreign currency after some time. And if the foreign currency value rises as compared to domestic currency, so it means in terms of domestic currency, B will have to pay more. So that's the concern for B. So what is the solution? Okay, here comes the role of the forward contracts. So what is the solution? The solution for A is to sell foreign currency at the forward exchange rates. So by selling foreign currency at the forward exchange rate, A will actually lock in the exchange rate for the future. A will lock in the exchange rate for the future. And what about B? For B should buy foreign currency at the forward exchange rate. That will also imply that B will lock in the foreign exchange rate for the future. Now, what? See, why over sell over here and why buy over here? Why A is selling? Because A is an Indian company, as I mentioned, right? And as an example. So A is TCS. So it's better that TCS is going to sell euros at a fixed rate in the forward market right now itself, so that when the euros are received later on, this forward contract will enable TCS to sell this foreign currency at the locked in exchange rate. Okay, so this position is known as the short forward position, and this position is known as the long forward position. So actual sale of foreign currency is not happening over here. This is just an agreement where A has agreed to sell foreign exchange at a predetermined exchange rate. Okay, so that is what the solution for A is. And for B, the solution is that B has agreed to buy foreign currency at a predetermined exchange rate. Because if suppose, because now B will not have to worry that what will happen if the foreign currency will rise. B already knows that when B has to pay in the future, when B has to pay foreign currency in the future, it can always buy the foreign currency at a fixed rate, which it has locked in, and then pay it to the other party. Okay. And when A is going to receive the foreign currency, A can always sell that foreign currency at the predetermined exchange rate that A has locked. So this is the short position where a party agrees to sell the underlying. This is the long position where the party agrees to buy the underlying in the future. Okay, so let's see the payoff of a long position in a forward contract. So the payoff is given by ST minus K, where what is ST and what is K? So let's just see this diagram first. So K is the delivery price, ST is the price of the underlying at time T. Okay, so if we assume that capital T is the expiration over here, so the payoff will be ST minus K. So let's take an example. Let's say if K is 50, okay, and ST is 60. So it means that, let's take a simple example. Let's say I and you enter into a forward contract where the underlying is say rise, okay, and let's say the base currency, we choose that we are going to deal in Indian rupee. So the delivery price, I am in a long position, you are in a short position. So I agree to buy a certain quality of rice, which we have decided mutually at 50 INR. Okay, INR we also call it as rupees for international candidates, just I'm referencing. So I agree to buy rice at 50 rupees per kilo. Okay. And let's say the market price at that time, when the forward contract is about to expire or just expires, is 60 rupees per kilo. So what is my payoff? My payoff is actually 60 minus 50, which is 10 rupees per kilo. Because in the market, if I wanted to buy the same thing in the market, I would have to pay 60 rupees. But now I only have to pay 50 rupees per kilo. Okay, so maybe we agree that we'll agree the enter into the contract, and the total value of the underlying will be in terms of, say, the quantity will be 1,000 kilos or 100 kilos, whatever. So based on that, we'll multiply 10 by the required number of kilos by the quantity, and we'll get the total profit. Okay, so obviously the payoff for the long position in this case is positive. Now, what about the short position? What about you? You agreed to sell me, right? You agreed to sell this same thing to me at 50 rupees per kilo. So what is your payoff in that case? Your payoff is actually just the opposite of my payoff. So K minus ST, which is nothing but negative 10 rupees per unit. So you are actually suffering a virtual loss. I am making a virtual profit over here. Okay. Now, what are futures contract? Futures contract are similar to the forward contract only. Their payoff structure is similar. But the only difference is that forwards trade in the over-the-counter market and futures contract, they trade on an exchange. Of course, there are some more differences which we'll explore later on. So this is the basic difference first. Futures are exchange traded, forwards are over-the-counter. Now, what are options? Options are derivatives that give the holder the right but not the obligation to buy or sell an asset at a predetermined price in the future. So they also trade on both. They trade, in fact, both on exchanges as well as in over-the-counter markets. So you might have done this chapter on exotic options. Can anyone tell me most of the exotic options in general, they are exchange traded or over-the-counter? Most of the exotic options in general, they are OTC. Absolutely correct. Okay. Now, there is a lot of confusion I see among the candidates that is any option, let's say a call option or a put option, is any option giving you the right to both the short as well as long position, or is there any obligation also to one of the parties? So some of you are already clear with this concept. So just to clarify this slide encapsulates everything together, and also we'll see which kind of outlook is generally, yeah, I think there's a question. Yes, absolutely right. So I was mentioning that we also see what is the outlook which leads to the taking up of long positions and short positions in the options, both call and put. So first, let's discuss a call option. So call option gives the option holder. Option holder means the long position. Remember that. See, when we define the right but not the obligation, this right is available to the option holder. Who is the option holder? The long position is the option holder, not the short position. So this long position in the call option, this position, this participant or this investor, whatever you want to call it, arbitrage or speculator, this position has the right to buy. Okay, so if this long call has the right to buy the underlying at the predetermined price, but not the obligation. So what about the short position? Short position is the other side of the trade, the party with the other side, on the other side of the trade. So short is also having the right, or short is having the obligation? Tell me. I mean, one of the answers we've already got, but is it clear to everyone that short call will always have an obligation to sell when the long exercises its right to buy? Okay. So remember, when long exercises its right to buy, short is always having an obligation to sell. Okay, what about long put? What about long put? So long put gives the option holder the right to sell the asset at a predetermined price. Okay, as of now, we are not discussing American and European, the difference. As of now, we are just discussing options in general. Okay, because there is a specific difference with respect to when that right can be exercised. But as of now, we are just discussing the basic difference between call and put options and long and short positions. So long put has the right to sell. So can you tell me what about short put? What about short put?
Obligation to
Very
buy.
good. Yes. So the short put will have an obligation to buy when the long exercises his or her right to sell. Okay. So this is a very important point. Now tell me one thing. This right, should it be given for free or it should have some value? If long is always having a right and no obligation, should it be freely available? It should have some value, some premium. Correct. Absolutely. And short is always taking an obligation. See, short is always taking an obligation. So the entire risk, you can say, most of the risk is borne by the short position. If something goes wrong, short position, since it's always having an obligation, short position is always having a higher risk. Okay. Again, this is not without loss of generality. Again, I'm saying, because in general, these things are correct. But if the market situation is, say, quite neutral, then some of my arguments might not hold good. But I'm just saying these things in general, that in general, short will have a higher risk as compared to long, because if the market situations become very, very unfavorable, then short is in a very bad position to lose a lot of money. So tell me one thing, if short is having this obligation, the short should always be compensated, right? So long pays the premium for this option to the short position, whether it is call or put. As long as it's a long position in a call or a put, the long position will pay the premium to the short, and the short position will receive the premium from the long position. Okay, so these are very important points. That's why I said there are many concepts which are encapsulated together with respect to long, short, right, obligation, call, put, premium as well. And another concept which we'll encapsulate in this slide only. Okay, you might have noticed that these two are in green color and these two are in red color. Okay, so when the investor is having a bullish outlook, then either a long call or a short put. Both of these positions signify a bullish outlook, whereas a long put as well as a short call signify a bearish outlook. Okay, the perception is, again, I mean, they don't signify a bearish outlook or bullish outlook from the perspective of the entire market. No, just from the perspective of the person who is engaging in these transactions, or the market participants who are engaging in these transactions, okay, and who are taking these positions. Clear? Fine. Now, what about the payoff? So this is the payoff structure for a long call position. This K is known as the exercise price, and ST is the asset price at time T. Now, one thing you can be very, in fact, if you don't even remember that max equation, the payoff equation of long call, it's quite easy to determine what will be the equation for the payoff. So if ST is greater than K, will the right be exercised? Tell me. If ST is greater than K, will the right be exercised? Yes. The right will be exercised. And in that case, the payoff is positive ST minus K. But what if ST is less than equal to K? Okay, if ST is less than equal to K, so in this zone, there is no point of exercising this option, because the same thing you can buy in the market for a lesser price ST. Why will you exercise the option and buy for a higher price K? Okay. So in this zone, the option is not exercised, whereas in this zone, when ST is greater than K, the option is exercised. Now, if you combine 1 and 2, you get this equation actually. So this equation gives you both these scenarios in a single format. Okay, max ST minus K, comma 0. And of course, there is something called as profit, because as of now, we are only dealing with payoff. Payoff does not consider the premium. If you want to find out the net profit for the long call position, you will have to subtract the premium, because that is the cost for the long position to enter into the long call, or to enter into the this or to trade into the long call position. Okay, so this is the profit for the long call position. And of course, for the short position, it will just be the opposite. So negative of whatever we discussed earlier, negative of max ST minus K comma 0. So that's why I said, you can see, is there any zone where the payoff for the short position is becoming positive? No. So why will any participant enter into such a contract where the payoff is always either 0 or negative? What is the motivation for the short position, guys? What did we just discuss? What is the motivation? Absolutely correct. The motivation is premium. So that is why short position should be compensated with the premium. It is very, very important, right? Then for the long position, this is the payoff diagram. You can see there is a cap for the payoff of the long position, in fact, which was not there for a payoff of a long call position. For a long put, there is a cap. You cannot go beyond this because the price of the stock cannot become negative. So in this zone, when ST is less than K, the right is exercised. Okay, so I think just a minute. Sorry, yeah. So in this zone, when ST is less than K, the right is exercised and the payoff is K minus ST. Because of course, when ST is less than K, then you as a long position in a put option, you would definitely like to sell the asset at a higher price K than its current market price ST. So then you get a positive payoff. But if the value of the underlying asset is greater than equal to its delivery price, then what is the point of exercising this option? See, very carefully. In fact, I think this is a mistake which many books have made with respect to this equal to sign. Now, you might be wondering why equal to sign over here and not here. Because see, even if ST is equal to K, will you exercise the option? Because in both cases, whether you exercise or not exercise, when ST is equal to K, in both cases, the payoff is 0. So rationally, what will you do when ST is equal to K? Will you waste the option in that case? Even if you waste it, you're getting nothing, right? So what is the point of wasting it? So that's why I think equal to sign should be placed always in case 2 when option is not exercised, whether it is put or a long. Okay, when option is not exercised, you have equal to sign over here. Okay. Anyways, that is not a very big deal, but I think it makes the perspective of a rational investor quite clear. Okay, now if you combine both of them, yeah, so I was saying when ST is greater than equal to K, obviously the market participant will like to sell the underlying at a higher price, which is its market price. Why will the market participant exercise the put option and sell it at a lower price K? So that is why in this zone there is no payoff. So if you combine these two, you get this as the payoff max K minus ST comma 0. Okay. And of course, to calculate profit, you subtract the premium again. And for the short position, this is the opposite structure of the payoff. Payoff is negative of the payoff of the long position. Now, there are three main categories of traders in the derivatives market. You have hedgers, you have speculators, and you have arbitrageurs. Okay. Now, hedgers, they use derivatives to reduce or eliminate risk exposure. So let's take an example. Let's say you have a US Treasurer A. So it's a very similar example that we discussed, we started with earlier, okay, for forward contract. Now, the same thing, maybe we can use options to illustrate the same concept, okay, the concern part and how the treasurer should try and hedge. So if the concern, the treasurer is has to pay 1 million euros, so it's a US treasurer and it has to pay foreign currency. So what is the concern for A? Again, in terms of foreign exchange, what is the concern for A? That euros will appreciate or depreciate? Euros will appreciate or
Appreciate.
euros will depreciate? Very good. So the concern is euro will appreciate. That is the concern. Now, instead of forwards, which we already have taken an example of earlier, let's say we deal with the hedging part, say using options. So the US Treasurer hedges by using call options, where the lock-in price, the price at which the euros have been locked, is 1.3 per euro. So $1.3 per euro. You can write dollars over here. Okay. Now, let's say after 6 months, the spot exchange rate is $1.2 per euro. Will the option be exercised? Think and answer. By exercising the option, perfect. Why will it not be exercised? Because the option is not exercised. Because the treasurer can directly buy from the market at $1.2 per euro. Why will the treasurer spend extra, okay, and give $1.3 per euro? So of course the option premium is lost, but the main motivation behind hedging is still risk management. Okay, it's not to gain extra profit. So even if suppose there has been some virtual loss in terms of premium, still it's a good decision, right? I mean, forget the hedging instrument. The hedging instrument might be something else, but in terms of risk management, it's still a good decision, even if a virtual loss has been suffered. Got it? Because the concern was appreciation of euro, not depreciation. So this is something which the candidates always ask, that what is the point of hedging then? The point of hedging is that the US treasurer was not able to predict. The concern was, maybe the perception was euros will appreciate. Okay, and that's why, based on the perception and the data that they had, they tried to hedge. Okay, it's like an insurance, absolutely. Okay, so from a risk management perspective, it's still a good decision. Now tell me, what will happen if S 6 months? It means spot rate is $1.5 per euro. Option will be exercised, and the treasurer will be able to buy euros at $1.3 per euro, and then the treasurer can pay 1 million euros by buying 1 million euros at this rate after 6 months. Okay, fine. Now let's take another example. Let's say B is another party which has to receive 1 million euro. It's again a US party. Okay, US party. Maybe a company which has to receive 1 million euros in 6 months. What is the concern? Euro will fall or euro will rise, or appreciate or depreciate? What will you say? Euro will appreciate or euro will fall? What is the concern? Perfect. The concern is euro will fall. So what should be the approach? Which option should be used? Or call option, if we are talking about option, call option or put option? What do you think? Very good. Put option should be used. Okay, so this is a put option. This is the approach. Let's say this is the strike price which was available, $1.2 per euro, and time is 6 months. So if after 6 months, the price becomes $1.05 per euro, the option will be exercised, correct? What will happen if the price becomes 1.25? So if the price is less than 1.2, the option is exercised. What will happen if the price becomes 1.25 after 6 months? Will the option be exercised? No, the option will not be exercised. Okay. Now, these are some practical examples. See, these are not theoretical examples. I'm telling you why. There is some level of practicality, because in theoretical examples, things become a little more clear. But over here, you get an extra insight. What is the insight? The insight is, what will the party do after that also? Because this is something which confuses some candidates. If B is receiving, it's about to receive 1 million euro, then why put option? Okay, because what is the concern? The concern is that euro will fall. And once B receives 1 million euro in 6 months, if the exchange rate, okay, becomes $1.05 per euro, the party has still the option of selling these 1 million euros at a predetermined price of $1.2 per euro. If the party did not buy this put option, if the party did not enter into the long position in the put option, the party would be forced to sell these 1 million euros at the market price of $1.05. But yeah, the opposite can also happen. The party might also suffer a virtual loss. The premium might be lost. Why? Because if suppose the exchange rate becomes $1.25 per euro, then the party will receive 1 million euros in 6 months and the party will sell those 1 million euros at the market price because the market price is higher than what the option is offering. Okay. Then we have speculators. So derivatives also allow risks to be taken with a relatively small upfront payment. In this sense, they have much the same effect as leverage. So how these derivatives give you the leverage effect? Let's take a very quick example. Let's say we have a stock with current price of $40. Okay. Now, oh my God. See, please stop. Okay. So the price is $40. Now, there is a call option which is available on A, this stock, with the strike price of $42. Okay. The call premium is $3 and T is the time to expiration. Now you have $12,000 with you. There are two options, two choices, I should say, because when I use the word option, it can be a bit misleading because we are discussing options. So you have two choices. First choice is to buy stocks. So using $12,000, you can buy 300 stocks, correct? Agreed? Let's be active. Obvious questions also, just say yes. Some of you, even if one or two people reply, it's okay. Is it okay? 300 stocks you'll be able to buy using these $12,000. Okay, how many options you'll be able to buy? Let's say you invest all of your money in buying options. How many options you can buy? How many options?
4,000.
Perfect, 4,000 options. Initial investment is same in both the cases. What will happen if the stock price becomes $50? Then at expiration, in the first case, the total profit will be the price of the stock, final price of the stock minus initial price of the stock multiplied by number of stocks, which is $3,000. Whereas in case 2, the payoff is $32,000 and the total profit is $20,000. So you can see by investing the same amount of money, this leverage effect inflates your profit so much by a factor of more than 6, in fact, in this case. But what is the downside of this strategy? Let's see what is the downside of this strategy. For that, we have to analyze what happens to your profit for different asset prices at expiration. We are assuming that this T expiration is 3 months. Okay. So in 3 months, if these are the asset prices, 30, 35, 40, 45, and 50. Now in the first case, what is your profit from only asset purchase? If you invested in stocks only, what is your profit? Anyone, please? What is the total profit? Remember, 300 stocks, 40 was the initial price. 300 stocks, 40 was the initial price. What is your profit? Of course, it will be negative. How much negative?
3,000.
3,000, correct. And what about options? What about options in this case? What
0.
is your profit? But what is your profit? Payoff is 0. What is your profit? Payoff wise, you're correct. What about profit? You invested some money, as option premium. What happened to that? It is completely gone, right?
1,200 minus 1,200.
Exactly. So for asset purchase, your profit is negative 3,000. But for options, your profit is negative 12,000. You have lost the entire premium. There is no payoff. The premium is lost completely. So this is the downside of this strategy. So leverage, that's why we say, what is leverage? Leverage is a two-edged sword, right? That is what we say in finance. So although it can give you very handsome profits, many of you who might have dealt with, say, the futures markets, say commodity futures, if you have any experience of gold futures, crude oil futures, you might have seen this leverage effect a lot in futures also. So leverage, if it gives you handsome profits, if things turn favorably for you, it also has the effect of giving you very big losses if things go against you. Okay, so you can see for 35 also, when the asset price is 35, the profit from asset is negative 1500. But for options, it is negative 12,000 again, 8 times loss. 40, 0, the profit is 0. And of course, this is infinite times loss if you see mathematically. Only when the price of the asset starts going above 42, or I think the initial price was, sorry, 40. No, strike. What is the strike price of this option? Yeah, 42. Only when the price goes above 42, some recovery happens for options. So for 45, 1500 is the profit from asset purchase, and for option it is 0. So 45 is a break-even level for profit. For payoff, the break-even level was 42. In fact, I'll not call it break-even level because on the left-hand side there is no payoff. But in terms of profit, the break-even level for options is this price, 45. At 45, you break even. Yeah, after 45, you gain handsomely, massively. Of course, if it becomes 60, it will be even more. It will be huge. So the growth is kind of, you can say, exponential, if not exactly mathematically exponential. Metaphorically exponential, I should say. So these are the profit strategy, profit from the two alternate strategies. Then there is a third class of market participant, which are arbitragers. Now, arbitrage involves taking advantage of inconsistent pricing across two or more markets. So an asset which provides no income, let's take an example directly. Okay. So let's say the current price is 50 for that asset. Risk-free rate is given to you with annual compounding. And we'll see these things in properties of interest rates. Now, assume that the 1 year forward price is $52 on this asset. So how will you get arbitrage profit? So what are the steps? The steps are, first, what you do is you borrow $50 for 1 year at 3% and purchase 1 unit of this asset. As of now, in these steps, the 3 steps that we're going to do, we are seeing the how part. We are not seeing the why part, remember, because many candidates after watching or by looking at all these steps, they might see, okay, fine. When these steps are already given, then things are quite clear. But I think many of the candidates have this doubt that how to construct this arbitrage in the first place, right? So that also I'll come to later on. Initially, I'll give you a brief overview in this chapter, but this arbitrage is discussed in great detail later on. So don't worry at all. So if suppose you borrow $50 for 1 year at 3% and then purchase 1 unit of the asset. And then what you do is you enter into a forward contract to sell this 1 unit of asset for $52 after 1 year. So tell me one thing, at time t is equal to 1 year, when you execute this forward contract, you have to, right? It's an agreement. How much money you get by selling the asset? If you execute this forward contract after 1 year and you sell one unit of this asset, so obviously how much money you're getting after selling this asset? Just the amount of money. I mean, I'm not asking about the payoff or anything. You sell this asset, how much you get? Absolutely correct. $52, right? So at t equal to 1 year, you simply sell the asset and you get $52, right? How much money you have to pay to the bank? Let's see. You had borrowed $50 for 1 year at 3%, right? So how much money you have to pay to the bank? The initial principal plus 3% of this $50, it's for 1 year, so $51.5. What is your arbitrage profit? $0.5. Correct? So you pay $51.5, you are still left with $0.5. Did you invest any amount of your own money? Did you invest any amount of your own money? No. So this is arbitrage. So this is a riskless profit, right? You did not invest anything. You still are gaining a profit of $0.5 without any investment. Okay. So this how when these steps are executed, then you are getting this arbitrage. How you are getting this arbitrage? It's quite clear by executing these steps. But why you are executing these steps? How in the first place you know that you have to borrow $50 for 1 year and you have to short this forward contract? Because if you see the second position, the second step is nothing but taking a which position? A short position. So how do you know whether you have to take a short position in a forward contract or long position? That is the main idea which we are going to discuss in brief, as I said right now. Now remember, when the actual forward price is greater than its theoretical forward price, when we'll see valuation on forwards or futures also today. So as of now, just remember, when the actual forward price is greater than its theoretical forward price, then what you do? It suggests that the forward contract is actually overpriced as compared to its expected value, right? So in this case, very good answer. In this case, you will actually tend to short the forward contract. Okay, because you are betting on the price to decline to its theoretical value, but the contract's maturity, that is the practical thing. But even if it does not, still, I mean, you can execute these transactions and you can have a. But if suppose the actual forward price is less than the theoretical forward price, then it indicates that the forward is underpriced. In that case, you will go long on the forward. Okay. So when you understand how to calculate this theoretical forward price, which depends on many factors like the spot price, the interest rates, time to maturity, all these things will be incorporated. Then you compare what is the actual forward price against the theoretical forward price. Okay. And in fact, this equation will also have a role to play. If you see the calculating the future value, it's you can say the forward price is somewhat analogous to calculating the future value. But again, we'll discuss that later. So is the idea clear? Is the Y part also clear? So this is the Y part. Why you are doing this? Okay. Yes, correct. So this is the why part and this is the how part. Why we shorted this forward contract? Because the actual forward price, which is 52 in this case, was greater than its theoretical forward price. Okay. And how we executed, these are the first three steps. Okay, that's it. That's it for this lecture. We'll just start the next one. So we'll start futures markets. And as I mentioned earlier, in the before we start into class, that we'll try to cover today's class as soon as possible, maybe in 2.5 hours. Okay, so because we are going to cover 5 to 6 chapters today, probably 6. Okay, and if time permits, then 6, and if not, then 5 at least. So long position, short position, all these terms we have seen, right? What is a long position? Long position means you are agreeing to buy the underlying at a predetermined price in the future. That means you are taking a long position. Short, you already know the opposite. You are agreeing to selling. You are agreeing to sell the underlying at a predetermined price. Then quality is also important for a futures contract. Okay, it has to be specified. Contract size has to be specified. Delivery arrangements have to be specified. Delivery months have to be specified. Price quotations, tick size, daily price limits, and position limits. These features are very, very important. Please go through them. Just their definition quickly. When you go through the theoretical part later on, just go through the definitions quickly. Now, basis is something which will be discussed in another chapter also. This is just introduced over here. The difference between the spot price and the futures price is known as basis. In the FRM curriculum, basis is strictly defined as spot minus futures, not futures minus spot, but it can be futures minus spot also. I mean, it completely depends on the convention being followed, but over here and in most of the places, this is the convention which is followed. Basis is equal to spot price minus futures price. Now just remember that when time approaches maturity of the contract, then futures price is same as the spot price or converges to the spot price and basis converges to 0. So when you are at the maturity, basis converges to 0. So let's see the operation of margin accounts. We have margin account. We'll see the concept of, again, all these things we'll see through an example. Then we have a concept of marking to market. Marking to market means that every single day at the end of the trading day, the value of the contract is marked to market based on the changes in the price of the underlying. Then all these things we understand by example only. Then there's something called as the initial margin, which is the initial amount that you have to put in your margin account to open your position or to initiate your position. Then you have maintenance margin. Maintenance margin is that margin below which, if your margin account balance goes, you get a margin call. And then you have a variation margin. Variation margin is that margin which you have to deposit in your margin account once you get the maintenance margin. The only thing that you need to be careful about from the exam perspective is, remember that variation margin is not the margin which the deficit which will bring it back to the maintenance margin. No. Once you get a margin call, so once your margin account balance goes below the maintenance margin, you have to deposit a variation margin so that you can top up your margin account balance back to the initial margin. That is very, very important. Absolutely. Okay, everything we'll understand using an example also and a figure also. It will be very clear. All these terms will be very clear. Okay. So let's take an example. Let's say you have the futures price of February 2023 contract. Okay. On, let's say, the morning of 6th January 2023. It's say $110 per barrel. Okay. The contract size is 100 barrels. And yes, except in short sale. The total number of contracts being traded is long position in 5 contracts. Initial margin is $3,500 per contract and maintenance margin is $2,700 per contract. This is given to you. Over here, I want to throw a word of caution. Practical applications also we need to discuss a little bit over here. Because see, those of you who have had an exposure to the futures market, again, I'm saying they might be knowing this, that the initial margin and maintenance margin, they are never defined in dollar terms, right? They are mostly expressed in percentage terms, percentage of the price of the underlying, right? And also the percentage does not stay constant. What happens when the market becomes too volatile? What happens to the margins? Do they increase or decrease? If the market is extremely volatile, forget the direction. It can be positive, it can be negative. Yes, the margins always increase. In fact, in multi-commodity exchange of India, if you see, in normal markets, there you might find commodity futures where the margin is only 4%. Only 4%. But in volatile markets, the margin for the same commodity, when the underlying is the same, okay, the margin for a futures contract for the same commodity, it can also increase to 25%, 30%, even 40%. So this completely depends, because see, the exchange knows that within a matter of hours, the movement can be so drastic that the entire margin account balance can be wiped out. So that's why they increase the initial margin and maintenance margin requirements. Okay. But for the sake of simplicity, we are assuming that the margin stays constant. Okay. So this is a example which has been constructed just to make the calculations simple. Otherwise, the margins also change. So let's do a quick calculations first. So total number of barrels, you can see, since the contract size is 100 barrels and you are dealing in 5 contracts. So total barrels is how much? 500. And total value of those 500 barrels is how much? Because the price of each barrel is $110. So total value of the 500 barrels is $55,000. And for one contract, the total initial margin is $3,500. So the total initial margin for 5 contracts is $17,500. So you can see that this is also, over here also the leverage effect is quite clear, because just by depositing $17,500, you are able to deal in $55,000 worth of the underlying. Okay, so there is definitely a leverage effect. And the total maintenance margin is 5 times 2,700, which is $13,500. Okay, so these calculations clear to everyone? Are these calculations clear to everyone? This will be February, guys. Okay, February. Okay, fine. Now let's see what will happen. So these are the dates which are given. Okay, just show the calculation straight away. So I've just written again, maintenance margin is 13,500, initial margin is 17,500. Okay, just for reference so that you don't have to go back to the previous slide. OMAB is opening margin account balance. CMAB is closing margin account balance. MC is margin call. Okay. And again, another simplified assumption has been made over here that the price on the previous day, the closing price on the previous day will be same as the opening price on the next day. Practically, is it true? Tell me, especially for these kind of commodities, crude oil, where there are markets like you get the WTI and Brent, they trade 24/7, right? 24, if not 24/7, then at least most of the time they are trading. I mean, if there are say holidays or something like that, then the trading might stop sometimes or some under some exceptional circumstances. But Brent and WTI are trading most of the time, right? But in Indian markets, MCX is closing at 11:30, right? Say for commodities. Okay, so obviously overnight whatever changes happen in crude oil, and once the MCX is closed, let's say there is a war between say right now we are discussing the war situation, so we can talk about Israel and Iran. So there's a war suddenly which breaks out after the MCX closes, right? And next day when the markets are open, the opening price is already $15 more, right? So this is possible. Correct. Gap up, gap down. So for the sake of simplicity, we are just assuming that the concept over here is that opening price is same as the closing price on the previous day, which will mean that opening margin account balance is same as the closing margin account balance on the previous day. Okay. So your initial margin was 17,500. So your opening margin account balance in the first day was 17,500. Okay. So what is the profit per barrel in crude oil? $2. You can see the price increased by $2. So total profit will obviously be 2 times 500, which is 1,000, right? Because there are 500 barrels you are dealing in. 1,000. So your margin account balance, which was 17,500 earlier, now $1,000 is added to this, and your margin account balance becomes 18,500. Will there be a margin call? No, there will be no margin call because the maintenance margin is 13,500 and your margin account balance is still above the maintenance margin. So similarly for the second day. Now again, this margin account balance gets carried forward to the next day, 18,500, as the simplified assumption we are using. And then next day you have a profit of $750 based on the price movement. There is no margin call again. Next day, there is a heavy loss of $4,250. The margin account balance, closing margin account balance becomes 15,000, but still there is no margin call because if you compare it with 13,500, you are still safe. Next day, there is again a heavy fall. Your closing margin account balance becomes 10,000. Will you get a margin call? Would you get a margin call? Okay, yes, you will get a margin call. So once you get a margin call, you have to replenish your margin account balance to what level? To the initial margin or maintenance margin? You have to replenish this 10,000 back to the initial margin. So you have to pay 7,500. So this is the whole idea. So marking to market means that basically the settlement that was taking place every single day. Okay, the positions were marked to market based on the closing price every single day. Okay, and you are getting, in fact, that it happens every moment, I mean, theoretically. So taking this day closing at the point where you get a margin call is again a simplified assumption. It happens during the day only. During the day only, if your margin account balance is falling below your maintenance margin, you will get a margin call immediately. And what will happen if you don't replenish your account? What will the exchange or broker do on your behalf?
Settle.
Exactly. Yes, they will close or offset your positions in proportion of whatever deficit you are having. Okay. Now, if you want to draw and represent everything using a figure, a very simple figure. So this is the best representation you can have. So this is your initial margin. This is your maintenance margin. Okay. Now you see, once your margin account balance is over here, you start at this point. Okay. You increase the margin account balance increased initially, right? So if it is increasing, it's an excess. Okay. Now there are some rules with respect to interest also on this excess, but again, that is not a part of the curriculum, so we'll not discuss it. Now, once you have this excess, no problem at all. Your initial margin, then your balance falls a little bit, then it falls to such an extent that it goes below the initial margin. Still, there is no problem. You're not getting any margin call. But as soon as your margin account balance falls below the maintenance margin, you get a margin call and you have to replenish your margin account balance to such a level that it goes up to the initial margin. And this difference, this amount by which the margin account balance had to be replenished, had to be deposited, this amount is known as the variation margin. So is the figure clear? Is the figure clear to everyone? Okay. Okay, now this is a figure which represents quite clearly bilateral clearing versus clearing through a single CCP. You can see there are two parties which are engaging in trades with each other. Okay. Whereas over here, the central counterparty is taking the opposite side of each trade. Now let's discuss the concept of volume versus open interest. This is also something which I've seen candidates getting a little confused about. So we have taken this example. This is the trading activity. On day one, A buys one options contract and B sells one options contract. So volume is 1, open interest is 1. C buys 5 options contracts and D sells 5 options contracts. The volume is 5, open interest is 6. A sells 1 options contract, D buys 1 options contract, volume 1, open interest 5. Last day, E buys 5 options contracts and C sells 5 options contracts. Both are 5. I'll explain this. But tell me to how many of you it is not clear? Volume, open interest, not clear. Or at least one of them is not clear. Maybe volume is clear, open interest is not clear. Maybe both are not clear, maybe both are clear. So are there candidates to whom these two things are not clear? Not clear. Okay, because this is a question which can be asked in the exam. Okay, so let's just try and dissect all these days properly and the volume and open interest calculation. Okay, OI is not clear. Okay, so let's see volume first. So see, for volume in day one, party A and B, there is one long and one short position, right? There is one long and one short. So what is volume basically? Volume is the total number of contracts which are traded each day. Okay. And it will be equal to the number of short or long positions. So both will not be, we will not add 1 plus 1. So one long, one short means one contract was traded because it's only a single contract, right? In a single contract only, one party is going long, one party is going short. Correct? So volume represents the total number of contracts which were traded on that particular day. Okay. Next. Day one, the party A is having one long and one short position. Day two, two parties engage, C and D. So 5 long and 5 short. Day three, again, only one contract is traded between A and D. Okay, so volume is pretty clear to everyone. I'm not going to day 4. Volume is pretty clear to everyone. Okay, now let's discuss open interest. So for open interest, the first day, open interest is 1. What is the meaning of open interest? Can you tell me? What is the difference between volume and open interest? What is the
Open is the
difference?
total contracts available.
Exactly. So the number of open contracts, or you can say the number of contracts outstanding. Can I say that?
Yes.
So on the first day, since only one contract was traded, so only that contract is outstanding. Now, next day, if you see, next day, this contract which was traded previously between A and B, it is still outstanding, right? It is still open, right? Both the parties have not taken any position to offset either the long position or the short position, right? So this is completely open even on day two. And this is one more contract. In fact, these are 5 more contracts which are now open between C and D also. So the total number of open contracts on day two is one between A and B, which was open since day one, and the other between C and D, which has been opened today. So that's why the total open interest on day two is 6. Is it clear? Is it clear? To everyone, those candidates who were saying open interest is not clear. Okay, great. Day 3, A has actually offsetted his contract. So A's contract, A's position has now been closed. Who has replaced? In fact, who has offsetted? D. Who has offsetted D's position? A's position, sorry, D. So A, which was having one open long position, is now having no position. It has been completely offsetted. Whereas D has now entered into one long position. So D, who was earlier 5 short, becomes 4 short. Is this clear? The position of D is clear on day 3. Is the position of D clear on day 3? Sorry, there's some noise in the background. Okay, so how many contracts are open on day 3? You can see 5S, 5L. So it means 5 contracts are open on day 3 also. Okay, so is the 5 open interest on day 3 clear to everyone? This is open since day 1. You can see that B has not taken any position since day 1. This position has been offsetted. Okay, and one of these positions has been offsetted. So it means that the open interest has reduced by 1 unit. Okay, is this 5 clear to everyone now? On day 3 to everyone. Shall I repeat? Shall I repeat this? Day 3 again? I need an answer. Otherwise, I'll not be able to proceed, right? Okay, I'll repeat. I'll repeat day 3. Fine. So on day 3, what happens is that A sells his one options contract. So A was earlier in a long position in one contract. So when A has sold one options contract, it means A has actually offsetted this contract. Okay, so A's position is settled. That is why we have 0. Okay, Vishal is asking, can you please elaborate on offsetting? Offsetting means taking an opposite position and closing of your position. That is the meaning of offsetting, Vishal. Because you might have seen the mechanisms of delivery. I mean, for futures contract, physical delivery hardly takes place, right? Most of the contracts, more than 99% of the futures contract are settled by this offsetting process only. So if you have a long position, let's say in crude oil futures, then taking a physical delivery of crude oil, or say doing a delivery of crude oil, delivering crude oil to the party, the opposite party, is not something which is done generally unless and until the participants involved are specifically interested in physical delivery. Generally, traders, they actually take an opposite position and they try to offset, and that is what we call offsetting or closing of your position. They try to close off their position by entering into an opposite position. That is the meaning of offsetting. Is it clear, Vishal? So if A is 1, so you are saying why is D not having 5S plus 1L since it offset A? Exactly. So this, try and understand, this is exactly what has happened. See, A is having 1L plus 1S over here. So this 1L and 1S, they are offsetting each other. Got it? That's why it becomes 0. And the same thing is happening with D also, Vishal. So 5S earlier, okay, plus 1L. Now you can break this 5S into two parts. See, can I write 5S as 4S plus S? So I just write 5S as 4S plus S plus L. Got it? Now this S plus L means offsetting, finished, 0. Understood? So that's why only 4S is left. Is it clear now? Got it? So is it clear? Okay, fine. Okay. So S plus L means the offsetting is complete and your open position is now 0. So the open interest reduces by 1 unit. Okay. So for day 4, again, it should be quite obvious. For day 4, it should be quite obvious because if you see, for day 4, what has happened? E buys 5 options contracts and C sells 5 option contracts. So on day 4, nothing has changed in terms of open interest. Why? Because the only thing which has happened is a new market participant E has completely replaced the market participant C. All the positions of C are taken by E now. Nothing new has happened, right? So you can see this 5L, which was there with C earlier, has now been taken up by E. So this is one way you can understand this, or else you can do the L plus S part also. Since this has become 5L plus 5S, it means it has become 0. Got it? So is it clear? Day 1, day 2, day 3, day 4? All the open interests? To everyone? Everything clear. Great. Okay, next. So this is a very important point which can be asked in the exam. Okay, fine. Next. Now, in a normal market, the futures price, they increase with the maturity of the contracts, whereas in an inverted market, futures price, they decrease with the maturity of the contracts. Now, let's conclude with this table discussing the brief differences between forwards and futures. They are over-the-counter contracts, forwards. Futures are traded on an exchange. Forwards can be customized. They are standardized. Forwards have one delivery date for each contract. Futures can have range of delivery dates. Forwards, generally, the settlement is done at the expiration of the contract, whereas for futures, settlement is done on a daily basis, and that is what we call as mark to market, the operation of margin account balance. We have already seen the example, right? Every day settlement is done. And in forward, settlement done generally via delivery or cash, generally. Whereas in future, just now we discussed, in future, settlement generally done via offsetting of positions. In forwards, the basis risk is less because of customization. Whereas in futures, actually, the basis risk is more. In fact, this might seem a bit counterintuitive to you. You might feel that, okay, these are standardized, then why basis risk is more? In fact, the reason they are standardized is actually one of the prominent reasons of basis risk. Because it's possible that maybe the underlying commodity might not be the same. Okay, and this will be discussed in detail in the next chapter also, so don't worry. Remember, they have more basis risk, they have less basis risk. These are less liquid. They don't have any secondary markets, of course. Uh, they are very liquid because of standardization and regular trading is taking place. Okay, so that's it for this chapter. We'll start the next one. So we'll start FMP 8 using futures for hedging. Now, a short hedge is a hedge in which the hedger takes a short position in the contract. Now, this is again something which will seem a bit counterintuitive when I explain the position in the spot market. Now, when you own or receive or about to receive certain asset, then you are actually long in the spot market. So this is quite reasonable. This is obvious. If you're owning something or if you're receiving something, it means you are long in the spot market. So if you are long in the spot market, it is guaranteed that for hedging, you should actually short the futures contract. Okay. Now let's say today is 13th of August 2023. Let's say the company will receive asset X, 100 units of asset X in November 2023. Okay. The spot price is $55 per unit. The futures price is $54 per unit. So you short the futures. Okay. What will happen if the spot price becomes $47 per unit? What will be your payoff? Can you tell me? We're just revising this concept. What will be your payoff from this hedge? In fact, payoff from the forward contract only. Let me forget hedge. Forward futures, whichever instrument you're using, just the payoff from the futures contract or forward contract.
-7.
-7, correct. Because see, unlike options, you don't have the right. It is a obligation all the time. It is a commitment. So that's why when you compare options and forwards in terms of terminology also, futures and forwards, they are known as commitments, whereas options are known as contingent claims. Just like insurance contracts are in contingent claims, right? So when the contingency happens, so in case of insurance contract, there's a contingency, maybe some disaster, some accident, right? So that is the contingency upon which the insurance claim depends. Similarly for option, the contingency is price of the underlying, shifting below or above the exercise price. That is the contingency. But forwards and futures, they are not contingent claims, they are commitments. Irrespective of whichever direction the price is moving, you have to actually execute the agreement. So over here, since you are shorting the futures, the spot price is 47. So payoff is how much? -7 or +7? What do you think? Correct. You remember for the short position, the payoff was K minus ST, correct? So K is how much? K in this case is the delivery price only. This is only K. Okay. So you might be given this in the form of a statement, but you need to identify that this is your K. This is the price at which delivery will take place. Okay. So if the spot price is 47, you still have the you can still execute the forward contract or futures contract and sell this asset for $54. Okay. So your payoff is +7, not -7, +7. You are short, not long. Got it? So this can be confusing initially, but you have to be very, very sure that you are reading the question correctly in the exam. I clearly mentioned short in futures. If this is K, this is ST, payoff has to be positive. And remember, these are theoretical examples, not practical ones, because practically offsetting happens. Practically, this is not how the contract is settled, right? You're not going to take or make delivery. So that's a different scenario. But in a scenario where we are assuming delivery and everything, the payoff is simply 7. So you are actually using the forward contract and you're able to sell the asset at $54 rather than its market price of $47. Now tell me one thing. If suppose, and I have asked this question earlier also in FMP4, again I'm asking, if suppose the price of the asset instead of 47, instead of 47, if it becomes $60 per unit, then what is the payoff? It's a virtual loss, right? Because the payoff is negative, right? The payoff is how much? 54 minus 60, which is -6 per unit. Because if suppose you sold this same thing in the market, you would have gotten $60 per unit. But since you have to execute the forward contract agreement, you are only getting $54 per unit. So now tell me again, from a risk management perspective, would you still call it a good decision or a reasonable decision from a risk management perspective only? Yes. Okay. Generally, again, I'm saying not always, but yes, generally, yes. Because the concern was that the price will fall down. That is your concern. Correct. And you'll be able to sell at a lower price. You have to sell at a lower price. That is your concern. That is the problem, right? Exactly. Very good, Vishal. It is not about, I mean, see, and consider this from the perspective of not only a business, from an individual's perspective only. Let's say from the perspective of a very small farmer. For the small farmer, what is more important, gaining extra profits or not suffering a loss? What is more important for a farmer? A very small farmer. What is more important, gaining heavy profits or not suffering a loss? Yes. For the farmer, maybe not suffering a loss is more important than gaining those extra profits. So even if the farmer's prediction, the farmer's assessment of the market is wrong, the price goes up to $60 per unit. Let's say we are talking about a farmer over here. The farmer still can, has locked in the price at 54. Farmer is still satisfied because the farmer was concerned what will happen if the price goes down to 47 or 45. Okay. So yes, farmer was not able to gain that extra profit of $6, but it's still okay from a risk management perspective. Okay. But yeah, when you'll see later on, this is one of the arguments against hedging also. So that's why I said not always, but generally this is the case. It's still a good decision. Now, long hedge is a hedge in which the hedger takes a long position in the contract. Now, as I said, this part will seem a bit counterintuitive. So if you are about to buy in the spot market in the future, tell me, in the spot market, you are in a naturally long position or a naturally short position? Think about it. You have to buy in the spot market in the future. You are in a naturally short position or a naturally long position? Exactly. Everyone will say long. I knew that. Everyone is wrong.
Thought that you don't have
Exactly.
exposure.
You are in a naturally short position because see the difference. You already own or you are about to receive something. You don't have to buy it. Then you are in a naturally long position. Maybe the farmer is about to harvest the crop. The farmer is in a long position in the spot market. But over here, you don't own it. Got it? You have to buy it. So this is something which you have to be very, very careful about. Buying in the spot market in the future means you are in a naturally short position in the spot market. Whereas if you are owning something and if you are if you're about to receive something, maybe a currency or maybe crop, whatever, you are in a long position. Okay. So in this case, you are going to go long in futures. So for example, if today is 13th of August 2023, there is a company which needs asset Y in November 2023. Now what we can do is we can just reconstruct this example to make this point more clear. Why naturally short and why over there naturally long? Naturally long was quite clear, own or receive. So let's say we are talking about a farmer who's about to harvest crops, corn. Okay, we are talking about corn over here. So the farmer is about to own this say 1,000 bushels of corn. Now, this is a perspective, let's say, of a cornflakes company. This cornflakes company needs raw corn to produce cornflakes. Okay. So even if you are not clear with this idea that why the company is in a naturally short position, you still know that the company needs corn. So the company has to lock in the buying price. Agreed or not? The company has to lock in the buying price or the selling price.
Buying price.
Exactly. So the company has to go long in the futures, which means it was naturally short in the spot market. So is it clear? Even from the opposite side, if you look at it, it will be more clear maybe. Maybe naturally short position, if it is not clear in the first instinct, then you can consider it from the perspective of the futures contract and then decide, okay, you were in a naturally short position in the spot market. Is the idea clear what I'm saying? Is the idea clear? Okay, so remember that when you own something or you're about to receive something, then only you are long in the spot market. But if you don't own something and you're not about to receive something, you have to buy it. You are in a naturally short position. Okay. So again, the ideas are same. If suppose this is the spot price and this is the futures price that time, and if that time at expiration the spot price becomes 6.7, then the company can always, of course it has to, company will execute the forward contract or futures contract and it will buy the asset at $6.2 per unit rather than its high market price of 6.7. So hedging purpose. Now let's see what are the arguments for and against hedging. So arguments for hedging. Non-financial companies, they don't have expertise in predicting financial variables, interest rates, exchange rates, etc. So if suppose the companies hedge, they can always focus on the main activities without worrying about these risks a lot. Companies can avoid unpleasant surprises. So these are the arguments for hedging. For companies, of course. But what are the arguments against hedging? So this is the first argument. That in theory, shareholders can hedge the risk themselves. Shareholders can diversify away the risks by investing across multiple companies. So companies don't need to hedge their own risk. I mean, shareholders can do it themselves. That is one of the points. But the problem is there is a counter argument to the second point. Even if the shareholders try, okay, the problem is that shareholders are always less informed than the management. Okay, so they will just do a normal diversification. But what exactly is going to happen with the company? What is the inside information? Those things. Okay, so there's a question first, and I'll first answer that, and then I'll continue. Jovik is asking, and just to repeat, for short hedge now in spot market, we are in a naturally long position. I'm just to repeat, short hedge now in the spot market. Yes, absolutely, absolutely. For short hedge, which was the first case over here, yes, for short hedge, you are in a naturally long position. Absolutely correct. Got it? Okay, so as I said, there is a counter argument to the second point that shareholders are less informed than the management, and the position may require only a small fraction of the one futures contract, which might not be available. So then there is another argument against hedging. It is about the variability of profit margin, especially when hedging is not a norm in a certain industry. So let's take an example when hedging is not a norm in a certain industry. Say, if hedging is not a norm, but still one of the competitors, one of the players in the industry tries to hedge. So what happens when hedging is not the norm in the industry? What happens? The prices of inputs will go up. So if the prices of inputs will go up, the companies will be forced to increase the price of the output also, right? Agreed or not? If suppose hedging is not the norm in any one industry, let's say we are talking about gold manufacturers. Gold manufacturers, they don't hedge, let's say, the price of gold, raw gold. Then if the price of raw gold increases, the price of gold jewelry also increases. Do you agree or not?
Yeah, they follow the industry.
Exactly. So in that scenario, if one of the players in the industry, especially a small player, if that player decides to hedge, okay, I will hedge the price of raw gold. If the prices go up, then it's good because the company has locked in the price, and the cost price for that company which has hedged, the cost price is low. So if the prices of raw gold go up, the cost price remains the same for the company, whereas the selling price, the price of the gold jewelry increases. It means the profit margin increases for this company. Do you agree or not? If the prices go up, again I'm repeating, we are talking about raw gold over here as an example. So for the price of raw gold for this particular company remains the same, the company which has hedged. But since the price of jewelry has gone up in the industry, I mean, based on the non-hedging pattern of the industry, the output price has also gone up. So it means the output price, the sale price is up, whereas cost price is the same. It means the company is having increased benefit. Agreed? Yes. But what will happen if the prices go down? If the price of gold goes down, raw gold, the company had already hedged the price of gold. So it means the company did not get the benefit of the decrease in the cost price of gold. So for the company, the cost price is still the same as earlier. but the selling price has now gone down. Agreed or not? Because the price of gold jewelry has also gone down. Once the price of gold goes down, the price of gold jewelry also goes down. So this leads to increased loss. So this is the case where the profits are more volatile. Whereas if the company is not hedging, then even when prices rise, both cost as well as selling price rise, profits are stable. If prices decrease, both cost as well as selling price decrease, profits are stable. So is it clear why hedging can lead to more volatile profits? Is the idea clear? Okay, fine. Then the last argument, as I mentioned earlier, that it is a virtual loss, basically. The virtual loss which we were discussing, that whether it is a good decision from a risk management perspective. But still, that is sometimes used as an argument against hedging, that hedging sometimes it may lose money. And if suppose it's a case of a farmer, then it's justified losing money, that extra profit, foregoing of that extra profit. But maybe for some businesses, this is not acceptable. Okay. Now, basis risk. As we discussed earlier also, the basis means the difference in the price of the spot and the future, spot price minus futures price. First, we need to understand that perfect hedges are not easy to implement because different asset contracts might be available and there is a lot of uncertainty with respect to time, or the futures contract has to be closed out before delivery. So it's possible that an airline company which wants to hedge jet oil prices, okay, now that airline company goes to the futures markets, but it finds that there is no contract where the underlying is jet oil. So what do? They try to find the closest, whatever is, there are some rules which we'll discuss later. So based on those rules, they try to find another contract. Then it is possible that there may be a lot of uncertainty with respect to time. When the what is the exact hedging period, it might not be clear. For example, for the farmer, the tentative date of the harvest might be known to the farmer, but the actual date will not be. So it's possible that there will be a contract which will just expire after or before the harvest date. So these things add to the problem. And in some cases, even though hedging has been done, sometimes some situation, unforeseen events happen, like say rains, heavy rains, and the futures contract may be closed out before delivery. Okay, so the existence of either one of those conditions gives rise to basis risk. Now, basis, as we discussed, is the spot price minus futures price, and basis will be equal to 0 when spot equal to futures. This typically happens at maturity. The change in basis over the hedge horizon is termed as basis risk. So change in this is basis risk. So let's draw a diagram. Let's say this is the diagram for the spot price, and this is the diagram for the futures price. So you can see that the basis is actually positive because spot price is greater than the futures price. The basis is positive. Okay. But what will happen if the spot price is below the futures price? What will be the basis in this case? Negative basis, because spot minus futures is negative. Now, if the basis increases and eventually finally see as the expiration is coming nearby, all these prices are converged. So spot price is converging to the future price, irrespective of whether it was greater or less than the futures price to start with. An increase in basis is known as strengthening of the basis, and a decrease in the basis is known as weakening of the basis. Okay. Now, this is a question which has been asked in the exam earlier, and this we have proved also in our PDFs in the videos, but we are not going to prove it today. We are going to completely omit the derivation part, but just remember the formula also. It's a very easy expression to remember. Remember, for a short futures position, if the basis strengthens, then the hedger's position improves. If the basis weakens, then the hedger's position worsens. As I mentioned, using an example, we have actually verified it. Okay, to an effect, in fact, we have proved it using symbols also, even without examples. For a long futures position, if the basis strengthens, the hedger's position worsens. If the basis weakens, the hedger's position improves. And at the heart of all these 4 points is the expression F1 plus B2. B2 is the final basis. F1 is the initial futures price. All 4 points are ruled by this expression basically. So this is what? This is the price which is paid by the long position. And this is also the price which is received by the short position. So if the question is asked in the exam, this particular slide can have two kinds of questions. One is, of course, with respect to this directly. What will happen to the short futures position if the basis strengthens? Okay, so the position will improve, of course. And the other question is how much price will be paid, or how much price will be received? How much price will be paid by the long? F1 plus B2. How much price will be received by the short? F1 plus B2. Just remember F1 plus B2. B2 is the final basis. F1 is the initial futures price. Now the asset that gives rise to the hedger's exposure. Just a minute, I'll just have some water. So the asset that gives rise to the hedger's exposure is sometimes different from the asset underlying the futures contract. As I mentioned, the example of heating oil, jet oil. This is known as cross hedging. And the contract which is used for hedging should be chosen considering the following points. When there is no futures contract of the asset being hedged, the contract whose futures price is most highly correlated with the asset price is chosen. So correlation is important. Remember, the first point is correlation. Second point, delivery month as close as possible to, but later than the end life of the hedge is chosen. So let's take an example. Let's say, as I mentioned, there is a airline company which wants to hedge jet oil prices. There are two oils available, oil A and oil B in the futures market. The underlying is oil A or oil B. The correlation of oil A with jet oil is 0.65 and the correlation of oil B with jet oil is 0.9. Which one will you choose? Option A, or oil A or oil B. Perfect. You will always choose oil B. You will go for a higher correlation. So first debate is settled. Let's discuss the next point, delivery month. Now, if I tell you that this is the expiration of the hedge, so for the jet oil company needs jet oil on or just before 5th of September, maybe 4th or 5th, okay? There are two contracts available. So you have chosen oil B, that is clear. So this is gone. Even in oil B, there are two contracts available. One is having an expiration of 28th September. The other is having an expiration of 31st of August 2023. Which one will you choose? September contract or August contract? Which one is closest? Correct. Closest is August, but you will still choose September. So even though closest is August, you will still choose September. Why? Because it's given close as possible to, but later than the life of the hedge. So you will never choose a contract which is before this 5th of September. You will never choose a contract which is before 5th of September. So is it clear? This kind of question can be asked directly in the exam. Is it clear? Okay, fine. Next. What is hedge ratio? Hedge ratio is the size of the position taken in futures contract to the size of the exposure. So size of futures divided by size of spot. Remember this. Don't get confused and don't remember the opposite. Sometimes I've seen candidates remembering it as size of spot versus size of F. Okay. So of course, when the asset underlying the futures contract is same. So as of now, what we are dealing, the problem that we are dealing with is the existence of other underlying assets as compared to the asset with which you or against which you want to hedge. So if the asset is same, then there is no problem. Hedge ratio is simply 1. Okay, but if that is not the case, then you have to do cross hedging. And cross hedging requires choosing a hedge ratio that minimizes the variance of the hedged position, not necessarily setting it to 1. So you don't want to set the hedge hedge ratio to 1 now when the asset is not same. You want to minimize the variance of the hedged position. And this is the formula that you get, optimal hedge ratio. Okay, where sigma s is the standard deviation of delta s. Technically, sigma s is the standard deviation of delta s. But if you want to simplify it, sometimes candidates say, or even questions are asked, that sigma s is the standard deviation of s. That's it. But in reality, it is the standard deviation of delta s. Okay. Sigma f is the standard deviation of delta f, or sometimes f for simplicity. Rho is the correlation between delta s and delta f, or sometimes between s and f directly. Does this formula ring any bells from quantitative methods? Does this formula?
OLS regression.
Yes, very good. OLS regression. So this was the slope or intercept. What was this? Or any formula which you remember from OLS?
Slope.
Very good. Yes. So this was the slope of the OLS regression line. So similarly over here, you perform a regression. Please mute your microphones. Thank you. You perform a regression against delta S and delta F. And again, I'm just emphasizing it over here. The regression dependent variable is delta S. This also is a mistake made by many candidates. They tend to believe that the dependent variable is actually delta F. No, the independent variable is delta F. The dependent variable is delta S. And then you carry out this regression and you have the optimal hedge ratio, okay, as the slope of this regression line, okay. So if H star is 1.5, basically you have to hedge using 1.5 units of futures for each unit of spot. We'll clarify this using an example. Okay, and again, delta S by delta F is not the same as size of S by size of F, because in terms of size, it was the opposite. Okay, this example will make it clear. What is hedge effectiveness? Hedge effectiveness can be defined as the proportion of the variance that is eliminated by hedging. Again, this is same as the definition of R square. So basically, the proportion of the variance which was explained, right? The amount of variance in the dependent variable which was explained by the variation in the independent variable, that was R square, right? So over here also it's the same. That is the hedge effectiveness. And once you determine the hedge ratio H star, you have the optimal number of contracts. So just a quick heads up to all the candidates, and of course you all know this, I've said this many a times, but those who are watching the recordings, I'm just saying them that this is the speed of the class that has been decided. I totally understand that I'm going very fast, but this is a crash course, so the speed has to be fast. Okay, it cannot be slow. There are multiple topics that have to be covered. So if you're not following anything, you can always watch our main videos, or you can definitely pause that part and you can just watch it once again, okay? Or for the theoretical parts, you can just go through the books in detail. So the speed will be this only because it's a crash course, okay? N star, and there are multiple things which we are skipping. For example, the derivation of H star, then why it is the size of S versus size of F, why not the opposite? All these things we have discussed in detail in the class. It's not possible to discuss because we are focusing very, very specifically on the exam. So once you determine H star, this will be N star, where QA is the size of the position being hedged, and QF is the size of one futures contract. So let's take an example. Let's continue with the same underlying assets and the same hedging instrument and the same commodity also which was being hedged. So jet oil. So let's say you have 500,000 gallons of jet oil. That is the amount that has to be hedged. Okay. So this is your spot asset. Jet oil is your spot asset. It is given that standard deviation of your spot asset. Again, for the sake of simplicity, sigma of delta S is not given, sigma of S. So the same formula can be used. Is given as 5%. You don't have jet oil available in the futures. You find that heating oil is the best contract to use. So this is your futures contract of heating oil. Okay. The hedging position. So sigma of futures heating oil. So F symbolizes the futures. Okay. Sigma of this futures position in heating oil is 4%. It is also given that the correlation between them is 92%. Okay. The contract size, each contract deals with 25,000 gallons of heating oil. Okay. So the first thing that you do is, first step is to calculate H star, the optimal hedge ratio. So H star is your 0.92 multiplied by 0.05 by 0.04. Same formula, 92%, 4%, 5%. Okay. And you can see sigma S is in the numerator. As I mentioned, that since delta S is your dependent variable, so that is why you have sigma S by sigma. If you remember, it was sigma Y by sigma X. Okay, so don't invert the formula by mistake in the exam. It will cost you one question and 1 marks. So even though your concept will be correct, you might do this mistake sometimes. So this is H star. So once you calculate H star, then you apply this formula, this one, QA by QF. So QA is the size of the position being hedged in units. Remember, not in dollars, in units. And QF is the size of one futures contract in units. So can you tell me what is QA? What is QA? What is the size of the position being hedged in units? How many units need to be hedged of jet oil? How many units of I want, can you just give me the exact number, please? The units which being, yes, 500,000. 500,000 gallons of jet oil is being hedged. Okay. And what is the size of each futures contract? 25,000. So this is your formula. 23 long contracts. Is it clear? Is it clear? Okay. So this is how the number of contracts is determined. Optimal number of contracts. Now, if the portfolio, let's say we are talking about stock index futures now. So if the portfolio mirrors the index, there will be question when you will be asked that find the optimal number of contracts when the portfolio mirrors the index. So this is the specific case of stock index futures. So can you tell me what is the implication, direct implication of portfolio mirroring the index for hedge ratio?
1.
Exactly. Hedge ratio is 1 because portfolio is completely mirroring or tracing the index. So as the portfolio moves, as the index moves, the portfolio moves accordingly. Hedge ratio is 1. Okay. Now in this case, VA will be the current value of the portfolio and VF will be the current value of the futures contract. How do you find out the current value of one futures contract? You find it out by using this, the futures price times multiplier. So index level times multiplier. So we'll see an example, it will be clear. So if you have a portfolio of $500,000, which mirrors the S&P 500, each S&P 500 contract is 250 times the index, and the index is at 500. Calculate the number of contracts to be hedged. So let's identify the parameters. I said this in quants also, and I'm saying this in FMP also, although in quants it was more important. That once you are able to identify the variables from the question and you are able to probably have proper mathematical notations for them if required, not very complex notations. We are not required to remember every formula, but at least we are able to differentiate. Okay, this is the meaning of VA or VF, these things. So this is your VA, right? This is the size of the portfolio, correct? What is your index level? 500. What is your multiplier? 250. So we just use the formula VA divided by VF, and VF is nothing but IL times M, right? VF is nothing but IL times M. So VA divided by IL times M. That's your answer. 4. 4. You'll get 4 actually, not 25. Yes, 4 to be hedged. Correct. So 4 number of contracts which are required to be hedged. Okay, but practically, investors don't have portfolios that will mirror the index. Okay. So in that case, the optimal hedge ratio is going to be beta from the capital asset pricing model. And then you have the same formula. N star is equal to beta times VA divided by PF. Now, see, one thing you might have observed over here initially, this formula is in terms of value. This formula is in terms of units. Okay, so accordingly, you have to adjust. Generally, you will find that in cross hedging, they will actually give you the question in terms of units only. So you have to adjust the formula accordingly. You have to use the units formula. Okay, but for stock index futures, generally you will find that they give you the formula in terms of value, because value of the portfolio, value of the index, all these things. Okay, they'll give you. So even if suppose the situation is changed a little bit, you don't need to worry at all. You just see what is given in the question, and based on that, you apply the formula. If units is given, use the first formula. If value is given, use this formula. So a well-diversified $150 million portfolio has a beta of 1.32. Okay. And the index level is given, multiplier is given. So it's very straightforward. This is your VA, $150 million. This is your IL, 2726. This is your beta, 1.32. And this is your multiplier, 250. So again, VA divided by IL times M, that was the expression earlier, but now this time you have to also multiply it with beta. So 290 contracts are required to hedge your exposure over the next month. Now, what about changing the beta? So if you have a target beta, okay, and this is the original beta. So if you want to change the original beta to a target beta, this will be the formula. Now, one thing, this formula will actually be helpful if this formula will also give you a positive or negative sign. So if suppose the target beta is less than your current beta, it means that you have to take a short position. So obviously this will become negative, right? It means, and the negative sign means that you have to take a short position. So this formula not only gives you the number of contracts, but it also tells you whether you have to enter into a short or a long position. Okay. And when beta star is greater than beta, it will be positive and you have to take a long position. So this is an example. Can you try and solve this right now? Send your answers, please, especially those who have never attended the FM classes. Can you please solve and send? And try to send via private message, direct message. So although we generally refrain from doing these exercises in the crash course, we did not do much in the last class also, giving questions to you all because it consumes a lot of time. But it's a very simple question. Try and give your answers, please. Long and short also, okay? Tell long and short also. Quickly. Anyone who wants me to go back to the formula, they can tell me, or I can write it down for you. The formula. Okay. It will be better if I don't write it down because it's a crash course. You're very near to the exam, so you should remember it. You should try and answer it. Okay. Okay, so we are getting correct answers. Very good. Okay, fine, fine. One answer is incorrect. Only one answer is incorrect. Otherwise, all are correct. Okay, so for the first one, you are getting negative 166. It means you are shorting 166 contracts, right? For the second one, you are going long in 74 contracts. That's it. Last part, stack and roll. Now, if suppose the hedge expiry is greater than the dates of all futures contracts, that is one condition. The other condition is liquidity concerns for far dated futures contracts. So in these cases, instead of going for a single hedge, you actually go for a stack and roll strategy. So what do I mean to say is, let's say you want to hedge, say, crude oil, and your hedging duration is 9 months. It's too long. So starting from now, let's say you want say 8 months or so, say December, that is your hedging horizon, December 2024. But there is no crude oil contract available for December 2024. What do? You actually take the near term contract, okay, and as soon as it is about to expire, you roll it over to the next contract, because when the new contract is about to expire, obviously the old contract is about to expire, then new ones automatically are available, right, for trading. So that is one reason why you might want to go for stack and roll, non-availability of contracts. The other issue, let's say hypothetically, even though December contract will never be available, 8 months, let's say hypothetically you manage to find a very long dated contract, December contract. Even then there will be a problem. There will be a lot of liquidity concerns for these far dated future contracts. In fact, we showed this. If you want, I can just show it right now only on the MCX website. We can just take an example because it will not consume a lot of time. Okay. Just a minute. So yeah, can you see the MCX website over here shared on the screen? Okay. So we are talking about, say, let's say crude oil. So let's go for commodity futures. Let's go for crude oil. So you can see there are 3 contracts for crude oil: April contract, May contract, and June contract. Expiration is, this one is 19th April, the second one, this is 20th of May, and this is 18th of June. The problem is 19th of April is already past, right? So that is why 20th of May is appearing above 19th of April. Otherwise, it would have been the opposite, of course. So you can see that if you compare the May contract, because the upcoming contract is the May contract, if you compare the May contract with the June contract, the far dated contract, which one is having more liquidity? How do you judge liquidity? Tell me. How do you judge liquidity? What is the best indicator among, if you see these parameters, tell me which one is a very good indicator of liquidity? Volume, very good. Volume, of course, if volume is very high, then of course liquidity is quite high because a lot of trading is happening, right? So compare this contract's volume. What is the volume for this contract? 21,000 lots, correct? What is the volume for this contract? 264. So the far dated contracts, in fact, we can go for another commodity also whose expiration date is probably on the 30th. So you'll have 3 options. Gold, let's go for gold. Yes, you have June, August, and October. Okay, compare the liquidity. See, 5th of June 2024, what is the volume? 9,000 lots. 5th of August, 2,000 lots. 4th of October, only 22 lots. So obviously liquidity is much less in the far dated contracts. So what will happen if liquidity is less? What are the implications of less liquidity?
High price.
What are the exactly the problem? Sorry, can you just repeat? I think I heard something.
Price will be high.
No, not price. Don't say only price, because even if price is high and you're going for a short position, that is still okay. More than the price, there is one more factor. If liquidity is low, there is one bigger issue at hand. Yes, not easily able to close, unable to unwind. But see, once the uh, hedge expiration is nearby, see, even if you're not able to close the position right now, your hedge expiration is still in December. So as you enter into the month of September, even this contract will become very liquid. So then you can still unwind. That is not a bigger problem. There is one more problem. Tell me one more problem, which is a serious problem with respect to liquid. Very good. Yes, yes, Rohit. Bid ask spread is the biggest problem. For illiquid contracts, the bid ask spread will be very high. And the bid ask spread is nothing but what you are paying to the broker, right? Because bid is the price at which you are selling and ask is the price at which you are buying. So if the spread is higher and higher, it means implicitly you are paying a cost. Is it clear? Although bid ask is going to be discussed in the crash course also, but this you already might be aware, right? You have prepared for FRM once. So everyone knows what is bid ask, what is bid and what is ask. Okay. So is the idea clear why there is a problem with illiquidity? Why there is a problem with illiquidity? Okay. So this is the biggest problem with illiquidity, the bid ask spread. Okay. And of course, unwinding and all, if you want to do immediately, then there's a problem. So it's a problem, but the bigger problem is you already have paid a bigger cost in terms of bid ask spread. But yeah, there is a risk of stack and roll also. The risk is rollover basis risk. So what if happens if you're rolling over and the basis is moving against you? So that is one of the biggest risks. Okay, fine. So that's it for this lecture. We'll start the next one. We'll cover properties of interest rates in two parts. Now, why we cover FMP 16 before the foreign exchange chapters and valuation of this forward and futures chapters? Because the concepts of interest rates are used over there, and these concepts should be clear to you before using those concepts. Okay, in FMP 9 and 10. So that's why we'll cover the first part of properties of interest rate, and we'll do it very quickly. Okay, so annual compounding, all these things are quite clear. So let's say if you have $100 as the initial principal, rate of interest is 5% per annum with annual compounding, and time is 4 years. So how do you calculate future value? You simply do this: 100 times 1 plus 0.05 raised to the power 4. So this should be clear to everyone. So I'll not go into detail at all. Similarly, for semi-annual, what you do, semi-annual compounding, you actually divide the interest rate by 2. So 5% per annum with semi-annual compounding. This statement is very important. Now, when you divide it by 2, so it means that it is actually 2.5% per semi-annum. So this will be given to you, but it does not mean the effective rate is 5% per annum. It means that it is 2.5% per semi-annum. Okay, and the annual rate will be different actually than 5%. So this is your future value. What you are doing? How many semi-annums are there in 4 years? 8 semi-annums. So you are raising it to the power 8, and this is your interest per period. Okay, this is what you get. Similarly, for quarterly, you actually divide it by 4 and you multiply the time index by 4. So 4 years means 16 quarters. Okay. Similarly, for monthly, what you're going to do is, for monthly, you're going to divide the interest rate by 12. Okay. And then you're going to multiply this time index 4 by 12. Okay. So this is the table basically, which gives all this data. You can see that there's a pattern. The value of $100 is actually increasing as the compounding frequency is increasing with the same interest rate. Okay. So if you want to calculate for weekly, you'll get this divided by 52, multiplied by 52. So it will be 122.13. This will be 122.1, but it is converging to a number. You can see that it is actually increasing and it is converging to a number. So what number it will converge to, that we'll discuss later. We'll not see the exact number, but the logic we'll see later. Okay, we'll see something which is known as continuous compounding. So that is the maximum compounding frequency that you can have, where you are actually dividing your time slices, okay, into infinite number of slices. The time is being divided into infinite number of infinitesimally small slices. That is technically how you will call it. Okay, so each time interval is infinitesimally small. So the smallest possible time interval is taken, and then you do the compounding. So that is your continuous compounding. So a theoretical formula is available for that as well. So this is the general formula, right? That is what we saw. Present value 1 plus the interest rate is divided by the compounding frequency, and time index is being multiplied by the compounding frequency. Now, one question which is asked frequently in the exam is conversion of one interest rate to other. You have to find an equivalent interest rate with another compounding frequency, and the formula we have derived actually in our videos, but we are not going to derive over here. This is the formula that you have to use. But I strongly suggest that this formula should not be remembered, because it is better, again, just like in quants also there were some sections. You just equate both sides, just make sure that the future value is same, and you will not need to remember this formula at all. So, but yeah, if you remember, then maybe you can do it a little quicker. Okay, but if there is even the slightest of trouble in remembering the formula, then do not remember the formula. Use the logic. So this is an example 8. This is the kind of question that can be asked. If the interest rate will be given with annual compounding, you have to convert it into quarterly compounding. So again, you have to identify which is your M1. This is your M1, annual compounding. You have to convert it into quarterly compounding. So M2 is 4. R1 is also given 8%. You have to find out R2. So you can use this formula and get your answer, or you can use logic. Now, as we discussed that the future value is actually converging to a number. Okay, so the more number of times you are compounding, the higher your future value is becoming. So what is the maximum compounding frequency you can have? Of course, infinity. As the denominator tends to infinity, you will get future value with continuous compounding, and this formula reduces to this when m tends to infinity. In fact, in the class we have discussed why it is true. We actually gave you a limit also, right? There was a limit in class 11, 1 plus 1 over x to the power x, where x tends to 0. The value of that limit was e. So that is how this e comes from. Okay, from that limiting value of that expression 1 plus 1 over x to the power x. But anyways, that is not in the course. You just need to remember that future value is equal to present value multiplied by e raised to the power rt in case of continuous compounding. Okay, so this is the formula to convert discrete compounding into equivalent continuous compounding rate, and this is the formula to convert continuous compounding rate into equivalent discrete compounding rate. Again, it's your choice. Either you can remember the formula, or you can just use the logic, equate future value on both sides, you'll get the same result. But these two formulas are simpler, I'll say. So maybe you can remember these formulas. So this kind of question can be asked. 6% per year with semi-annual compounding. Find the equivalent rate which should be expressed with continuous compounding. So what is M? What will be M over here quickly? Small m. Correct, it's 2. Okay. So M is 2, and you can just use the formula and you can get your result. And the opposite is given over here, this question. 9% per year with continuous compounding. And these questions you can solve while you are either going through the PDF or while watching the video once again. Okay. And just I'm repeating that the PDF of the old lecture hasn't been shared till now, but we will share, don't worry, because I can totally understand that while revising, probably it is not possible for you to watch the entire video. I mean, and it doesn't make sense also if you attended the class. So the PDF will be a very quick revision for you, right? So it will be provided, don't worry, in the LMS will be. So suppose an interest rate is 9% per year with continuous compounding, find the equivalent rate with quarterly compounding. So again, you can just simply use your answer and get the results. We are not doing the calculations because they are pretty simple. Now, discount factor. See, there was a formula for calculating future value from present value. So if you just invert the formula, you get present value from future value. Okay. Or you can say, I mean, just apply the negative sign to over here to m. This will come in the serve as the numerator over here, because 1 plus r raised to the power m, r by m, sorry, raised to the power negative mt is nothing but 1 over r plus 1 plus r by m raised to the power positive mt. We know that, right? So 1 by a b is equal to 8 to the power negative 2. That is what the logic is being used over here. So this part actually is the discount factor for discrete compounding. This part, 1 plus r by m raised to the power negative mt, or you can simply say 1 by 1 plus r by m raised to the power positive mt. So this is known as the discount factor. And for continuous compounding, this is the discount factor, e raised to the power minus rt. So what is the discount factor? You can see in both cases, future value is being multiplied by something to get the present value. And this something is your discount factor. So discount factor is the amount by which the cash flow is multiplied to get the present value. Okay. So let's go to bond valuation now. Let's take an example of a bond whose future value is given as 100. It's a $100 par value bond. Par value is 100. Time to maturity is 3 years. And the yield on the bond is not the yield. The coupon on the bond, it is a 6% per annum coupon paying bond with semi-annual compound. So this is the coupon, 6% per annum with semi-annual compound. So these are the features of the bond. And these are the current interest rates, semi-annually compounded interest rates. Now we have to be a little bit careful when we are valuing the bonds. The coupon frequency should match with the compounding frequency of these interest rates. Otherwise, you have to do some conversions or some adjustments at least. So to make it simple and straightforward, this example has been chosen where the coupon frequency is same as the interest rates, compounding frequency. And generally 6 months is the norm for most of the US fixed income instruments. They all are semi-annual coupon paying instruments, most of them. So basically what is happening? You are getting $3, $3, $3, $3, $3 at these points in time. And finally, you're getting $103. Why $3? Because the coupon was 6% per annum with semi-annual compound. So it means 3% per semi-annum, 3% every 6 months. What is 3% of 100? Was $3. So these are the cash flows from the bond. Now, in the exam, when this kind of question is asked, it is always a good habit to draw a timeline. If the question is a little complicated, not for simple questions, if the question is a little complicated, draw a timeline of all the cash flows. So you can see that plus 3, plus 3, plus 3, plus 3, plus 100 over here, which becomes plus 103. Okay, so what you do, you find out the present value of all these cash flows. So the present value of this first cash flow you find. So first cash flow, this 3. Okay, use this formula, find out the present value of 3. Similarly, the present value of other cash flows you find by discounting it to the correct time point. Okay, use the correct periods also. So tell me just one thing. If I have to discount this 3, although the total number of years is 1.5 years, but what is M? M is the period, right? It is not the number of years. So M was the compounding frequency, in fact, right? So what was the compounding frequency for this particular bond? Correct. Okay, so just use the same formula. It will be, say, for this $3, if I want to value this $3 over here, it will become 3 by 1 plus. Which interest rate you will use? Tell me. Which interest rate you will use? You will use the 1.5-year interest rate, right? So let's go back to this table. This interest rate you will use, correct? 4.4%. Okay, so you will use this 4.4% divided by compounding frequency is 2, and 2 multiplied by what? How many years? We are talking about 1.5. So this is how you will calculate the, in fact, this we are dealing with, I received at time, say 1.5. So we are taking just the third cash flow, just as a random example. So similarly, the present value of all the other cash flows can also be calculated. Okay. So once you calculate this present value of all the cash flows, sorry, it was already calculated. This one was calculated for the first cash flow. So this is for the first cash flow. Okay. 2.9557. This is for the first cash flow. Now, once you calculate it for all the cash flows, you can see these are all the cash flows. If you add all these present values, this number 102.0695 is the number which is the present value of the bond. So this is how you value a bond. Okay. And these are the respective discount factors, of course. So this is the present value of the bond. Okay. Now, what is the yield of this bond? The yield of this bond is basically that discount rate which equates the present value of all the cash flows to the market price. Now see, the interest rates are different. The 6-month interest rate, the 1-year interest rate, the 1.5-year interest rate, they are different. But then to find out the bond yield, you need a single interest rate finally. You know the value of this bond. Okay. So this single value of y, which will equate all these cash flows to its present value, that is known as the yield of the bond. Okay, so in the exam, will you be able to solve this completely? Is it possible for you? If suppose you are asked to find out the yield of the bond, you know what are the interest rates, you manage to find out the present value of the bond. Let's say this is the present value of the bond, you find it out. So what will you do in the exam? Exactly, you will use the financial calculator. So what you'll do, which are the TVM buttons? You start with N. So can you tell me what is the value of N in this case? What is the value of N quickly? For our bond, the 3-year semi-annual paying bond, what is the value of N? Yes, N is 6, semi-annual, right? 6. Present value, we already calculated, 102.0695. You have to make sure that a negative number, negative sign is given against 102, because the sign of the cash flows and the sign of the cash outflows and the sign of the cash inflows have to be opposite. There is no rule that PV has to be negative and FV has to be positive. Even if you do the opposite, even if you say do cash inflows as negative and outflows as positive, you will still get the correct result. That is how the calculator is designed. But this is the general convention. The only thing that you have to take care of is that they should be opposite in nature. So if one is negative, the other has to be positive. Okay. So if PV is negative, then PMT and FP will be positive. Do you remember what is PMT? What is the meaning of PMT? Regular payment, right? So in this case, it is the coupon. How much coupon we are receiving? $3. So PMT is 3. What is FV? What is FV? FV is 100. Perfect. So what are you going to find out now? I by Y, right? The yield. So CPT I by Y. Now you get 2.622739. Is this the bond yield? Or yes, absolutely. This is actually yes. This has to be multiplied by 2 because this is the interest per semi-annum. This is the yield per semi-annum. Okay, so the bond is yielding 2.622739% per semi-annum. And to find out the yield, it will be 5.2454%. Now, again, you have to be very careful over here. Is this 5.24% per annum? Tell me. Or you have to add something to it. What should I say? Is it per annum only? Or something should be added after this? This term should be added with semi-annual compounding. Okay? Yes. So this 5.24% is definitely per annum. But this is half correct. Once you don't write with semi-annual compounding, it will not be fully correct. So this is the yield on the bond. It means effectively it is giving you this much percent per 6 months. Okay, what is annuity? Annuity is a series of equal payments made at the end of consecutive period over a fixed length of time. So let's say there are these coupons are there, C, fixed equal payments. You just find out their present values, you get the value of the annuity. Now there is one important point, factor which we have introduced, which is annuity factor. This factor we have introduced to make one of the formulas easier later on. We'll see the formula of par yield. To make that formula easier, we have introduced the annuity factor, which is a standard term, but it was not included in the FRM curriculum. We have done it. So remember that annuity factor is nothing but the sum of all the individual discount factors. That is known as the annuity factor. Because when we frame the definition of par yield, it will be easier to remember. So par yield is the coupon rate that would cause the value of the bond equal to its par value. So now what will be the coupon rate which when discounted by the appropriate interest rates, not the yield. These are the actual interest rates by which these coupons are being discounted by. And if this results in the par value, the solution to this equation, the value of C is your par yield. So again, this is not possible for you to, in the exam to rewrite this complete equation and solve it. So it's better to remember it in this way. You define M as, of course, the compounding frequency. It's quite obvious. You define A as the annuity factor or the sum of all discount factors, or this is the way in which Garb book has defined the last one, the value of an annuity that pays $1 on each coupon payment day. But we will remember it as this or this because it makes our job easier. Also, we'll remember capital small d as a final discount factor, not like this in the way which Garb has defined it, because it makes our job a bit difficult. Okay. We'll just remember D is the final discount factor, A is the annuity factor, which means this is the formula for part. Okay. Fine. So that's it for properties of interest rates, part 1. We'll start with FMP 9. Let's start foreign exchange markets. So this is, you can see the size of the foreign FX markets, how it has evolved in terms of notional value. In fact, it is becoming quite big and it was always very big. Okay, now how the quotes are done. When an exchange rate is quoted, there is a base currency and a quote currency. So currency pairs are typically indicated like this: triple X, triple Y, or triple X slash triple Y, with triple X as the base currency and triple Y as the quote currency. Okay, so basically you are asking the question that 1 unit of triple X buys how much unit of triple Y. That's it. The exchange rate is basically showing how much of the quote currency is needed to buy 1 unit of the base currency. So opposite interpretation is also true. So you want to buy 1 unit, or you want to use 1 unit to buy how many units? So basically, how many units of triple Y will be required to buy 1 unit of triple X? Okay. So if suppose this is given to you, EUR USD is equal to 1.1. Can you tell me what it means? Does it mean $1.1 equal to 1 euro, or 1.1 euro equal to $1? $1.1 equal to 1 euro, or 1.1 euro equal to $1? Very good. $1.1 equal to 1 euro. That is what it means, because you can see the definition. How much of the quote currency is needed to buy 1 unit of the base? So over here, USD is the quote. USD is triple Y. How many USDs are needed to buy 1 euro? $1.1 are needed to buy 1 euro. It means $1.1 is equal to 1 euro. Okay. Then there are some conventions about which currency is the base currency when exchange rates are quoted. So for most of the currencies, you all know that dollar is the base currency for most of the currency pairs, right? But there are certain currencies which actually are the base currencies against the dollar. So these 4: pound, euro, Australian dollar, New Zealand dollar. In all these pairs, dollar is the quote currency and these are the base currencies. Whereas for other currencies, dollar is the base currency and the other currencies are the quote currencies. Okay, so how many rupees are needed to buy $1? How many Canadian dollars are needed to buy $1 US? Okay. Now let's come to quotes. So now spot exchange rates, they are generally quoted with 4 decimal places. Remember that. Okay. So let's take an example. Let's say for Euro USD, the bid is 1.1744 and ask is 1.1746. Okay. Now, forward exchange rates, they are quoted with the same base currency. And again, just a quick recap. What is bid? Bid is the price at which you can buy or sell. There are 2 perspectives. See, let's say you are the broker and I am the investor. So from my perspective, what is the buying price for me? 1.1744. So to buy 1 euro, I have to pay $1.744 or I have to pay 1.1746. Correct. I have to pay the ask price. So ask is the buying price for me and bid is the selling price for me. So you can see there is a bid ask spread. There is always a difference. Ask is always higher. It means implicitly, even if I buy and sell immediately, I buy at 1.1746 and sell at 1.174. Immediately I make a small loss, which is same as the bid ask spread. Correct. So that is why the broker is there for. The broker is facilitating the transaction. The broker has to earn commission, right? Why is the broker doing this anyways? Okay, so that is the implicit profit of the broker. But for the investors, from the broker's perspective, which one is the buy price? The broker is buying at. Correct. So basically, the broker is bidding this much to buy your asset. That is why bid price. And the broker is asking you this much to sell that asset. So that is why it is known as the ask price. So from the broker's perspective, bid is buying price, ask is selling price. Whereas from the investor's perspective, it's the opposite. Okay. Now, as I mentioned that the exchange rates, forward exchange rates also, they are quoted with the same base currency and they are shown as points. So this is the table that you might be given in the exam, the points table. So what you do is you actually multiply them by 1 divided by 10,000. So you divide it by 10,000 and then you add it to the spot code. Okay. Yes, so you multiply by 1 by 10,000 as I was saying, or divide by 10,000 and then you add to the spot code. So let's say if these are the points which are given to you, then how do you find out the 3-month forward bid price, let's say? Okay, so the bid price is given as 1.1744. Okay, and say for 3 months, this is the bid 80.87 and ask is 82.07 in terms of points. So what you will do to find out the bid price, you will simply divide this 80.87 by 10,000. So this is what you'll get. 3-month forward bid, you'll get this spot quote plus 80.87 divided by 10,000. So 1.182487. Similarly, you'll do it for ask. 1.1746 plus 82. You will divide this by 10,000. Okay. So now, initially, what is the bid-ask spread? Tell me. Initially, what is the bid-ask spread? Initial bid-ask spread is how much? What is the initial bid-ask spread? For the spot, I am asking. For the spot. What is the bid-ask spread for spot? 0.0002, absolutely. Okay. And what is the bid-ask spread for 3-month forward? So for 3-month forward, either you can subtract these two and you can get the bid-ask spread. Okay. Or else you can also do this. You can see what was the spot spread. It was 0.0002. You see what is the 3-month spread in terms of points. Okay. So this difference you divide by 10,000, you add it to 0.0002, you'll still get the same result. So rather than subtracting, this question can also be asked. Maybe they will ask you not to find out the actual bid and ask price 3-month. They will ask you what is the 3-month forward spread. So you will just see what is the initial spread, spot spread. You'll see what is the difference between these two. You'll divide it by 10,000, add the spot spread. That is the 3-month forward spread. So you'll still get 0.0032. Okay, this question can be asked. Okay, now 3 categories of risk which have to be examined. You have transaction risk, you have translation risk, and you have economic risk. Now, transaction risk is the risk related to receivables and payables. So let's take a case of receivables. Let's say you have an Indian IT firm. Okay, let's say in Infotech Solutions. It is specializing in some cybersecurity services, let's say. Now, this Infotech Solutions, this IT firm, has entered into a contract with a UK-based company, okay, to provide ongoing IT security, say, support. Now, this contract, under this contract, this UK-based company actually, can you just mute your microphone, please?
Mic on చేస్తావు కూడా.
I've done it from my end. Please keep your microphones muted. Thank you. So I said that under this contract, under this arrangement, so this Indian firm is going to invoice this UK firm in Great Britain pounds, let's say, because that's the operating currency for UK company. So they have agreed that, okay, you will invoice me in GBP. So in this arrangement, Infotech Solutions is exposed to some transaction risk because there will be fluctuations in this currency exchange rate, GBP INR. Because there might be some time difference between when the transaction is initiated and maybe when it is settled. So causing this cash flow from receivables, which will be, of course, in this case, the payments from the UK-based company, this will vary due to changes in exchange rate. So tell me one thing, Indian IT firm, should it go short in GBP INR futures or long in GBP INR futures? Think about it. It is about to receive pounds. Just remember the same logic.
Short.
Very good. It has to short because since it is about to receive, it means it is in a naturally long position in the spot market. Very good answer. So it should actually go short in the GBP INR futures because it will lock in the price in that. Okay, fine. Similarly, you can have the opposite case also. You can have payables. If you have payables, in case of receivables, you are going short. But if you have payables, you will go long. Okay. Now, this risk, transaction risk, actually impacts two statements mainly. It impacts income statements, it impacts cash flow statements. So cash flow statements, because of course the changes in cash flows will happen due to transaction gains or losses if you are settling foreign currency transactions. And I mean, as an extension, any realized gains or losses from foreign currency transactions will directly impact the profits. Okay. Now comes translation risk. So translation risk, it arises from assets and liabilities denominated in a foreign currency. These must be valued at in a firm's domestic currency when financial statements are produced. These can lead to foreign exchange gains or losses. So again, we can take an example of an Indian manufacturing company. Okay, maybe it has a subsidiary in Germany. This subsidiary is operating and maintaining its accounts in the German currency. It's euros. Okay. So at the end of the year, this company, say we call it as Bharat Manufacturing Company, it needs to consolidate all the financial statements, okay, to Indian rupees. So obviously, once it is consolidating everything in Indian rupee, it is definitely exposed to the change in exchange rate. So what financial statements will be affected?
Balance sheet.
Balance sheet will be mainly affected, right? And of course, other comprehensive income will also be affected. Assets and balance sheet will of course be affected as assets and liabilities in foreign currency are being translated over here. So definitely it will be affected, and other comprehensive income is also going to be affected. Then you have economic risk. Now, economic risk is a risk that the company's future cash flows will be affected by exchange rate movements. Now, this is something which you might say it is quite similar to translation or transaction risk, right? No. This is actually more long-term in nature, I'll say. So again, let's consider the same company, say Bharat Textiles or Bharat Manufacturing. Say Bharat Textiles. Bharat Textiles is exporting cotton fabric to Germany, okay? And it is invoicing all its customers in euros, okay? Now, there was a case of transaction risk that we discussed. So is the transaction risk over there applicable? Is the transaction risk applicable in this case? Of course, yes, it is applicable. I mean, if invoicing is done and then cross-currency conversion has to be done, it is applicable. But then there is a bigger type of risk, a long-term risk, which will actually lead to variability in the currency, impacting the price and demand. Because see, let's say if euro depreciates, what will happen to Bharat Textiles products in Germany? Will they become more expensive in euro terms or less expensive in euro terms? I mean, of course, we are assuming
More
that
expensive.
exactly.
More
We are assuming that the rupee cost base of their products is the same. There's no change. So definitely, Bharat Textiles products, they are becoming more expensive in euro terms. So this means that there can be a decrease in demand because of that. Because the customers in Germany, they might find that fabric very expensive. So the Bharat Textiles will have to lower the prices. It will impact the revenue. It will impact the profitability. Okay. It is also possible that if the euro is depreciating, a weaker euro will encourage competitors from different countries which are having, say, a stronger currency, stable currency. with respect to the euro, of course. And the competitiveness will also increase. So basically, there is a difference. We are talking about, when we were talking about transaction risk, we were talking about a short-term risk, and it was affecting specific financial transactions. But economic risk is much broader, you can say, and having a more strategic impact. Okay, so they are not the same, they are very different. That is the point. And as far as hedging is concerned, there are futures which we discussed, futures, forwards. These are available for hedging transaction risk, but for hedging economic risk, much you can say detailed, much more comprehensive strategies, diversification, adjustment of pricing, operational practices, revision, all these things are required to hedge economic risk. So they are very different. Okay. Now, these are the most important variables that influence exchange rate. Balance of payments. You all know what are balance of payments. Difference between exports and imports, right? Then inflation and the value of this, your currency is of course influenced by monetary policy of the central bank. Then nominal versus real interest rates. Now, nominal interest rates are usually quoted in the market and indicate the return that will be earned on a currency. And real interest rates are adjusted for inflation. So this is the general formula. R real will be equal to 1 plus R nominal by 1 plus inflation rate minus 1. We are assuming discrete compounding over here. And this can be approximated like this, and it will be 100% true for continuous compounding. This is an approximation of this result, and for continuous compounding, it is a perfect result. So this is also sometimes written as R equal to N minus A. And as I mentioned, these are exact if rates are continuously compounded. So if nominal interest rates is 6%, this inflation rate is 3%, then real is approximately 3%. Now, covered interest rate parity and uncovered interest rate parity. So in FMP 11 also something like this is going to turn up. No, not in FMP 11. FMP 11, I think the chapter code has changed. I'll have to check. So this is the formula basically. 1 plus R divided by 1 plus RF whole raised to the power T. I think it's in FMP 10, not 11, if I'm, because in valuing forwards and futures, it was there. Yeah, I think in valuing forwards and futures only, the valuation of forwards for currency pairs are also given. Yes. So I'm not sure about the chapter code over here. So anyways, this is the formula for calculating forward rate from the spot rate. Okay. And we have discussed this in great depth, that do not get confused into, judging which one is the domestic currency and which one is the foreign currency. It is always a bad idea, domestic, foreign, domestic, to remember the formula that way. Always use the logic. Which currency you expect to appreciate and which currency you expect to depreciate based on the interest rates. Adjust your numerator and denominator accordingly. Okay, don't remember that formula. Now, how many of you are clear with the difference between covered and uncovered interest rate parity? So we'll do it in brief, very brief. But anyone who's a bit confused or they believe that both are same, uncovered versus covered. Okay. So covered interest rate parity actually involves arbitrage arguments. It actually ensures that forward exchange rates, they will prevent any kind of arbitrage opportunities from differences in interest rates between the two countries. Okay, so that's why the hedging is done using forward contracts. So they are dealing with forward contracts, the covered interest rate parity. Okay, this is the forward price, this is the spot price. Now comes the important point. You can see very clearly that what will happen if numerator is less than denominator? F will become less than S, of course. So if the interest rate R triple Y is less than interest rate R triple X, it means F is less than X. It means in the forward market, the currency will be weaker. Okay. Whereas if the opposite is true, then of course F will be greater than S. I think there's a question. Let's check. Uncovered means whatever interest rate is. No, actually, see again. See, then you are not able to differentiate between the 2 points. See, you are absolutely right. That is interest rate parity. Okay. Chaitanya, that is interest rate parity. But what is the difference between uncovered and covered? That is the basic interest rate parity that you have said. Because whatever the interest rate is, we definitely deserve the same returns. Absolutely, right? Otherwise, it doesn't make any sense. Otherwise, an investor, why will an investor invest in a country with lower interest rates, keeping everything else same, right? But then there are special cases also. Got it? So this is the general definition. You're absolutely right. But the difference between covered and uncovered is that covered is based on arbitrage arguments and the forward and spot prices, the relationship between forward and spot prices. So covered interest rate parity says that exactly this relationship should hold good. Try and understand this point. Whereas when you talk about uncovered interest rate parity, it assumes that the future spot rate itself will adjust to equalize this difference in interest rates between the two countries without the use of any forward contracts. Got it? It is simply based on some expectation and an argument that the high interest rate in one country should be offsetted by depreciation of that country's currency against the other country's currency. Understood? Is it clear the difference? So both are actually in principle conveying the same message that the profits or returns, whatever you're calling, they should be definitely same. But the first one is conveying this through forward contracts. Okay, the second one, only spot rates are used. No forward contracts are used, and arbitrage is not used in uncovered interest rate parity. Okay, in the first case, arbitrage is because this relationship, if it does not hold good, then there can be straight away arbitrage by shorting one and going long on the other. Whichever is overpriced, you short that. Whichever is underpriced, you long. Okay. So that is what covered interest rate parity is. Uncovered is simply about spot rate. So let's take an example for uncovered. Okay. So let's say the exchange rate is just, I mean, although it's more than 80 now or close to 80. So, but let's assume that the interest rate is 75 rupees per dollar, 75 INR per USD. So I just write it down. Okay. You can also write it as like this, USD INR, just like this. This will be the quote currency. This is the base currency. So this is 75 currently. Yes, not. And we are also assuming that the interest rate in the US is 1%. And interest rate, sorry, this is the opposite. I think this should be 6 and this should be 1, right? Let's say this is 6 and this is 1. Okay, so if the current exchange rate is 75 rupees, now as an investor, say US investor, a US investor will borrow, say some dollars, say $1,000. Okay, so $1,000 at 1% interest rate that US investor will borrow, and they will convert this $1,000 at the current exchange rate. How many rupees they will get for $1,000? How many rupees they will get for $1,000? Correct, 75,000 rupees. So this 75,000 rupees they invest in India at 6% for 1 year, let's say. And for the sake of simplicity, everything is annually compounded, annual returns. Everything is per year. Okay. So can you tell me what will be the total interest earned and how much will be the total amount after 1 year? Total amount earned after 1 year, plus, including the principal amount. So principal is 75,000. How much will be the interest at 6%? 6% of 75,000 is how much? Fast, quickly. 4,500. So if we add 4,500 to 75,000, how much you're going to get? 79,500. So 79,500 is your final principal and amount. Sorry, not principal. Principal plus interest, which is the amount. Now, if the exchange rate remains stable, let's say the exchange rate does not change, it remains stable even after 1 year, the exchange rate is 75. Then this 79,500 can be again converted back to some dollars. How many dollars? How many dollars? 79,500 divided by 75. So can you tell me how many dollars? Okay, $1,060, correct? $1,060. So basically, see, finally it's an interest of 6% on 1,000. We could have calculated it directly only 6% on 1,000. But the point is that this is the process that will happen, right? Because if exchange rate had changed, then this would not be applicable, right? So if exchange rate has not changed, the investor is simply earning 6% on $1,000, and how much interest the investor is paying in the US market? Only 1%, right? Only $10. So $50 is the profit. This cannot happen, right? This cannot happen. So that is why this argument of uncovered interest rate parity states that the high interest rates of India will be offsetted by a depreciation of India's currency against the dollar after 1 year, so that the returns are equivalent. That is the whole idea. Is it clear? Uncovered interest rate parity, only spot rates are involved. Covered interest rate parity, forward rates are involved. Fine. That's it. Okay, I'm repeating the last line. I said that since this is not possible, this should not happen. Otherwise, every investor will only invest in India. Every US investor will invest in India, na? Right, Rohit? So that is why this high interest rate of India, 6%, it should be somehow compensated for, or it should be offsetted by a depreciation of the Indian currency against the US dollar. Okay, so that when the investor converts this 79,500 back to say dollars, the investor should get much less than 1,060. Got it? So exchange rate has to increase. It has to increase. The value of dollar has to increase. So rupee has to depreciate. That is the whole idea. Okay, fine. That's it for this lecture. We'll start the next one. We'll start pricing financial forwards and futures. Okay. So what is the investment asset? Investment asset is held solely. This is the last actually chapter, but we also have to cover FMP 16 part 2. We have done part 1 only. This is the last chapter, and then we'll cover part 2 of FMP 16. That's it. Okay. So investment asset is an asset that is held solely for investment purposes, at least by some traders. Consumption asset, primarily for consumption. Arbitrage arguments can be used to determine the forward and futures prices of an investment asset from its spot price and other observable market variables, but it cannot be done for consumption assets. Now let's see what is short selling. Okay, many of you are aware of short selling, but there are many intricacies which probably some of you might not be aware of. So let's say if you have there is an investor wants to short a stock X, short based on the expectation that maybe the price will fall, whatever is the reason. We are just discussing the mechanism, not the reason. So broker has to short X on investor A's behalf. Now, shorting, what is the meaning of shorting? Shorting means that you are selling something without having to own it in the first place. So you don't own it, you are simply selling it, and maybe in the future you will buy it, so that if the price falls, you actually get an implied benefit. Okay, this part we have discussed in great detail in our video. I do it very quickly. So obviously the broker has to find a way first to have that stock, right? Otherwise, without having it, how will you sell it? So instead of buying it, broker actually borrows it. Broker borrows it from a party B, let's say, which owns this stock. So B lends this stock to the broker, and the broker sells this stock X in the market on the investor's behalf. Okay. And of course, in the market, there has to be some participant to which it has been sold. Let's call that participant C. So now C has this stock X. So can you tell me, this is the mechanism that's happened. Okay. Can you tell me when the company pays dividend or any sort of income, who has the right to receive the dividend, B or C? B or C? Okay. So some of you are saying B, some of you are saying C. See, actually, the dividend should be received by C from the company. From the company, because the actual shares have now been transferred to C, right? C has not borrowed it. C has actually bought it. Rather, to understand this, company pays income to C, but there is a problem over here. Did B sell its shares? Did party B, if it's an institution, I call it it. If it's a person, he or she, has B sold his or her shares?
No.
No. So B should also get the income, right? B should also get the dividend. But in the company's eyes, C is the owner. So who will give that income to B? Exactly. A will be responsible to give any income, the same amount of income that company is paying to C. A will be transferring the same income to B because B has not sold, it has actually lent that asset. Okay. And of course, if there are two options, either investor A will ask the broker that, okay, my short selling is complete, let's return the stock or the share to B. In that case, broker will buy it from the market and return it to B. Or maybe B will demand, okay, I want my shares back even before A intends to close the short sale. So in any case, the broker will have to buy it from the market and give it to B. Now, this makes sense because of two reasons. This transfer any income to B by A makes sense because of two reasons. First, we've already discussed that B has not sold. The second is a very sound theoretical argument. What happens when the company pays dividends to the share prices? Tell me. What happens to the share prices when the companies pay dividends? They decrease. Theoretically, correct? Because the equity is going down, correct? So theoretically, if they are going down, then and theoretically they go down by the same amount that the dividend is paid, correct? So don't you think if they go down, then without doing anything, just because of that dividend, A has benefited because A was shorting the shares. So as the prices go down, A is actually benefiting. Do you agree or not? Right? So because of the dividends, A is actually benefiting. Not because of actually the short sale, not because of A's prediction, just because of that dividend. So that is why A should transfer that dividend to B. Got it? Yes, exactly. So if the prices go down further, then definitely A has that right to claim that profit, and of course A will get that profit. But the profit, just because of the dividends being paid, should be actually not given to A. It should be transferred by A to B. So that is the second argument. The first argument is, of course, that B has not sold, B still owns it, and A has to give it to B. Okay, now these are the notations we'll use. T is the time to maturity. S naught is the price of the underlying asset today. F naught is the futures price today. And F naught, whatever we will be calculating, that will be the delivery price also for later on. R will be the zero coupon risk-free rate. And this is the forward price for a no income asset. F naught is equal to S naught 1 plus R raised to the power T. Now, when we started the first chapter today, FMP 4, I discussed in the last slide, second last and last slide, that the Y part, which one is higher, which one is lower, which one to go long, which one to go short. How do you know how to execute the arbitrage step? It will be based on this formula. So if F naught is greater than this, then arbitrageurs will buy the asset and short forward. And if F naught is less than its theoretical price, then they will short the asset and long the forward. Because if F naught is less than its theoretical price, it means F naught futures is underpriced. So if futures is underpriced, go long on it, long on forward or futures, whatever you want to. Okay, so go long on it and then go short on the asset. So let's take an example. So it's a 4-month forward contract. It's a zero coupon bond. It will mature 1 year from today. This means that the bond will have 8 months to go when the forward contract matures. Current price of the bond is given, risk-free rate is given. Just find the forward price. What is T? It's a 4-month forward contract, remember. So T is 4 months or 1 over 3 years. Okay. So this is the 4-month forward. Okay. But the bond is still having 8 more months. So this is the figure which we have done just for clarity, just to make everything clear. Although there might be multiple parameters from this timeline we might not even use, but this is the question. The best, as in quants, I was saying, one of the best ways to solve questions is to try and identify the statements and convert them into mathematical notations. In FMP, mathematical notations, yes, for some questions, but for most of the questions, timeline becomes very important. If you're able to draw a timeline properly, your job will become much easier. Okay, what is the spot price? 930, risk-free rate is 0.06. So simply this is the F naught. F naught is 948.24. So we did not even need the timeline, right? As I told you, we will not even use some parameters of the timeline, but still it gives you more clarity on what is happening. Because there will be some questions where maybe you have to calculate the income, present value of the income. So you'll be very clear if you have the timeline, which components to consider, which components not to consider. Okay. Now forward price for an investment asset with benefits or costs. Now tell me one thing, if suppose I enter into a forward contract with you and for the next 6 months, it's a 6-month forward contract. For the next 6 months, since you are holding the spot asset, am I getting any benefit? Yes, Oliami. I'm going to the previous question once again. So this is the previous question. Any doubt? Please ask. Is it clear? Is it clear? Shall we proceed? Okay. So I was saying that, yes, okay. So the party which is holding the spot asset, that party is the beneficiary. All the benefits are being given to that party only. Okay. So the benefits which are associated with the underlying assets, they are actually subtracted in the calculations. It means that since the forward contract holder is not getting those benefits till the time of delivery, it means the forward contract holder is at a disadvantage as compared to the spot holder. So that is why the benefit should be subtracted. Very simple argument. Whereas costs, let us say I and you enter into a forward agreement and I will take the delivery from you after 6 months. But it's a very heavy asset. It's a commodity, let's say, with huge storage costs. It's a cotton. You're storing a lot of cotton. You need go down space. You have to pay rent and all. So as a forward contract holder, I don't have the spot. Am I incurring those costs as a forward contract holder? Am I incurring those costs, those storage costs? No, you are incurring the costs and then you will deliver the asset after 6 months to me. So it means I am at an advantage. I will get the asset after 6 months without having to bear the 6 month storage costs. Okay, so I'm at an advantage. So that's why costs should be added while valuing a forward contract. Benefits subtracted, costs added. Is it clear? Very important point, and that is how we'll base all the formulas. So this is a very simple idea which I illustrate to my students so that all the formulae which we are going to see with respect to cost and benefits, all of them are clear. Okay, benefits subtracted, cost added. So when you have benefits, the known income, you can see there's a subtraction sign. S naught minus I, where I is the present value of the income. So instead of S naught, it is replaced by S naught minus I. And of course, if this argument if this equation does not hold true, there will be arbitrage as discussed earlier. Okay, so consider a 10-month forward contract on a stock when the stock is priced at $50. It is assumed that the risk-free rate of interest is 8% per annum for all maturities, and the dividends are of $0.75 per share are expected after 3 months, 6 months, 9 months, and 12 months. So it's a 10-month forward contract, guys. And every 3 months, this is the diagram, timeline. Every 3 months, you are receiving dividends. But the life of the forward contract is only 10 months. This is the life of the forward contract. This is the life of the forward contract. So tell me, in your calculation of the present value of the income, I, will this have a role to play? That is why deliberately I have add 11 months to this question. Because if this will be given in the exam, you have to be sure that I is only the present value of that income provided by the investment asset during the life of the forward contract. So once the life of the forward contract is over at this point, you are not interested in any future income, not required in your calculations. Okay. So you just consider these three. And when you calculate the present value of these three, you will get 2.1653. Okay. And the same formula we are using, and we are getting approximately 51. That's it. Okay, so calculations you can verify later on. Now, if suppose this benefit is actually expressed as a continuous, as a known yield instead of a sure short present value amount or a cash amount, it's expressed in the form of a yield, then this will be the formula. Okay, Rohit is asking PV using TI. I think you mean TVM, right? Not TIM, correct? Yeah. So there are two options actually. In this case, yes, you can find out the present value using TVM. In fact, we have explained this in the video, how you can use a TVM and what will be the parameters. Yes. But in this case, you have to be careful. When you use TVM, what will be the future value? What will be the future value? What you will set as a future value? Can you tell me? Zero, correct. One more precaution you have to take. Is the interest rate given as quarterly compounding? So if the interest rate given as 8% per annum, so the mistake that you will do while using the TVM button, you will simply do 8% divided by 4, and this is what you will put in the IYY, correct? That will be your first intuition. Yes or no? But that is wrong. Why? Because the interest is annually compounded. So either you discount it separately one by one, or while you are using TVM, make sure that first you convert this rate into equivalent quarterly compounding rate and then divide it by 4 and then put it in the IYY. Understood? So you have to be very, very careful while using the TVM button. Okay, so that is why TVM button is a very limited button, I'll say. Those are very limited buttons because as soon as the interest rate environment is changing, they are not effective. You have to convert the annual compounding into quarterly compounding first, equivalent, and then divide by 4. Okay, so be very careful by using TVM. Okay, so this is the formula, and you can see that this can be expressed like this also. Why I have expressed it like this? Because just to make sure that this term is same, this term is still less than S, right? So basically, whether you write S0 minus I or you divide S0 by 1 plus Q to the power T, you are actually reducing the first term. So just to make the formula consistent across. And this is the formula for valuation of forward contracts or futures contracts. This also, I've seen many candidates getting confused in this part. I would advise you, remember it like this, S0 minus present value of strike price, finished, or exercise price. That is how you should remember it, S0 minus PV of K. Don't use the lengthy formulas of the book. Okay. Yes, it's mostly in discrete compounding. In fact, after 2020, they actually gave discrete compounding more than continuous compounding. Earlier, everything was continuous compounding before 2020 in FRM. Everything, almost everything. Okay, and of course, this will be the value of short position. So this is an example over here. Okay, time is given as 0.5 years. interest rate is given as 10%, S0, current stock price it is given as 25, delivery price is 24, K is 24. So what I said, just do S0 minus PV of K. So S0 is 25, S0 minus present value of 24. So present value of 24 is simply this much. That's your value of the futures contract. It makes your job quite easy. Okay. And one more thing, see, whenever you find that you have income, yield, the structure of all the formulas, not only for forwards and futures valuation, but also for pricing of forwards and future valuation, yes, but even for options. Even when you see put call parity, you know, S0 will be replaced by S0 minus present value of dividends whenever you have income, whenever you have dividends. So this structure is quite consistent across all the formulas. It is quite easy to remember it. Everything remains same. S0 simply gets replaced by S0 minus PVD if you can find PVD explicitly, or if it is in the form of yield, then S0 gets replaced by S0 divided by 1 plus some yield raised to the power t. It will be consistent across all the formulas. Again, I am repeating. Don't need to remember it. Okay, fine. So this is for income. Now, are forwards and futures prices income? This question has been, or I should say, it has featured maximum number of times in the last 15 years in GARP sample paper questions. This particular question. So, are forwards and futures prices equal? Yes, generally they are equal. Generally. But when there is a very strong positive correlation between stock price and interest rates, then actually the scenario is different. See, I'll tell you, I'll just explain you with you. So let's say the correlation between stock price and interest rate is positive. Positive correlation means what? Both will increase together and both will decrease together. Agreed or not? Interest rates and the underlying price. This is the underlying. S is the underlying. R is the interest rates. Both will increase together and both will decrease together. Correct? That is the meaning of positive correlation. I'm just asking the meaning of positive correlation. I have not explained anything right now. Is this correct? Okay. Everyone, come on. Okay. Now listen to this very carefully. It's very interesting. You know that futures are settled daily, whereas forwards are not settled daily, correct? So when the price of the underlying is increasing, when the price of the underlying are increasing, then futures position is having more gains. Of course, we are talking about long position only in both cases. Futures position is having more gain every single day, and it is being settled every day, correct? If the prices are increasing, then the futures position is also benefiting. Of course, the long futures will benefit if prices are increasing. Futures price will also increase without any doubt. So because of this daily settlement, the gains are being available immediately to futures. And since the interest rate has also increased, can I say that these interest rates, these increased gains can be invested at a higher interest rate? Yes or no? This should be answered by everyone. This should be clear to everyone that yes, I need a yes from everyone. Come on. If the futures price or the futures position is gaining in value, then because of the positive correlation, the interest rate is also increasing, and these increased gains are being invested at a higher interest rate. Okay. But if the price of the underlying is decreasing, it means the losses are also being marked to market daily. But at the same time, interest rate is also decreasing. So can I say that these losses are being financed at a lower interest rate? Agreed or not? Everyone. Gains are being invested at higher interest rate, whereas losses are being financed at lower interest rate. But for forward, there is no difference, because for forwards, you're not getting anything right now. You are getting everything towards the end. So that time, what will be the interest rate? That is a different matter, right? So who is having the advantage, futures or forwards in this case? Perfect. Futures is having the advantage. So that is why in this case, futures price will be greater than forward price. So the question is, when correlation between interest rates and underlying price is positive, futures price is greater than the forward price. And of course, the opposite is also true. Okay. When correlation is negative, then the losses are being invested at, the gains are being invested at lower interest rates and losses are being financed at higher interest rates. So in this case, futures price will be less than the forward price. This is the explanation. And of course, for thank you, Tanuj. If Q is the dividend yield rate, then the futures price is F naught S naught 1 plus R1 divided by 1 plus Q raised to the power. Okay. Same formula. Nothing has changed. The only thing that has changed is the underlying. Now it's a stock index. We are talking about stock index. So same formula. It's quite, if suppose there was no dividend yield, there was no Q, then this formula would be S naught into 1 plus R raised to the power T, and F naught will be equal to S naught times E raised to the power RT. Okay, in case of continuous compounding. Now in this case, it's continuously compounding, and you also have a dividend yield. So the formula becomes R minus Q instead of Q. Okay, so these formulas, yes, exactly. So these things have been discussed in great detail in the PDF, in the videos, how to write, when to write R, when to use R minus Q, when to use discrete, when to use continuous. In fact, we have a separate video for the equivalence of continuous and discrete rates also. So remember, these two formulas are for no dividends. And this is the formula for a continuous dividend yield of Q. Okay, now on currencies again. Now this is the point which I mentioned. See, rather than remembering which is the foreign currency, which is the domestic currency, it is always better to apply the logic of interest rate parity. You know that based on interest rate parity, the country's currency where the interest rate is lower, that country's currency should be expected to appreciate. It means that in the forward market, it should have a higher price. Okay, so based on this logic only, rather than remembering the formula, adjust your numerator and denominator. So let's take an example. Let's say you have 3-month Euro USD foreign exchange rate contract. It is available at $1.1565 per euro. LIBOR is given in both countries. Now tell me, based on both countries' interest rates. Okay, and by the way, LIBOR has already been phased out, so the interest rates might not be given in terms of LIBOR in the exam. So if US interest rate is 4%, Euro interest rate is 2%. Which country's currency should be expensive, should become more expensive, in fact, as compared to today? It should become more expensive in the forward market. Tell me.
Euro.
Exactly, Euro. Euro is expected to appreciate, and I mean, as far as uncovered parity is concerned, Euro is expected to appreciate and dollar is expected to depreciate. For covered interest rate parity, it will be explained in terms of forward price. Okay. Now, there is a twist in this question. The twist is that forward exchange rate is given, you have to find out the spot. So sometimes you can make this mistake. Sometimes you, in a rush, you might just miss out and you might think, okay, this is the spot, I have to find forward. So obviously Euro will depreciate. So this will happen. No. Since Euro is expected to appreciate in the future, it means today, the spot rate of Euro in terms of dollars should be less than this or more than this. Tell me. Now we are talking about the opposite thing. In the future, of course, Euro is expected to appreciate. But if you compare it with today, then will it be more than 1.1565 or less than 1.1565? Very good. If this was the spot, then you would say, after 3 months, it will be more than 1.1565 because euro has to appreciate. But this is already the future. This is already the data for the future. I mean, a forward exchange rate are expected futures, expected prices in the future only. Okay, so it means that when you apply this formula, okay, even if you are not sure about which one to put in the numerator and which one to put in the denominator, you are 100% sure that S0 should be less than this number for sure. It means if this has to be greater than S0, in the forward exchange, forward market, euro has to be higher. So it means 1.1565 should be higher than S0. So it means in the numerator, you should have a higher number. In the denominator, you should have a lower number. So these kind of mathematical logic, keep on applying these even while solving questions. Even if you are clear with the formula, you are 100% sure, okay, this will be the formula. There's no doubt about that. But keep on cross-verifying in your mind mathematically. Okay, this is something which is expected to appreciate. Okay, so this will be higher. So it means that numerator has to be higher. Is the idea clear? Is the idea clear? Okay, fine. So once you solve it, you get, of course, 1.15089. So this is the quote in the spot market. This is the quote in the forward market. Okay, fine. So again, it's stuck. Fine. I think this was the last slide actually of this lecture. So we'll start the next one. Okay.
Progress.
Okay, so we were discussing this, as I mentioned. This is the last slide. So we'll start the next chapter right now. Start the second half of FMP 16, part properties of interest rates. Okay. What is yield duration? Yield duration is the sensitivity of a bond's price to a change in its yield. This is how it is measured: change, proportional change in bond price or percentage change in bond price divided by the percentage change in yield. And of course, you can write like this also. You can just reframe the equation, rearrange the terms. You can write delta B by B. So whichever mode is more comfortable for you, you can use that based on the numerical also, which is being asked to solve. You can use the relevant formula. But of course, I think the best way to remember it is the first one. Duration is the proportional change in bond price with respect to the proportional change. Why this negative sign? Because there is a negative relationship between bond price and yield. As the yield is moving up, the bond price is going down. So the example we have taken, let's say duration is given, delta Y is given, bond value is given. You have to find out the change in bond price. Okay. Now just a quick recap. If you have to convert basis points into percentage, what you do? You divide it by 100. But if you have to convert basis points into decimals, you actually divide by 10,000. Okay, so 1 basis points is equal to 0.01%, or in decimal terms, 0.0001. So be sure about the units. Don't make mistakes in the exam. So this is the formula, or this is the formula, whatever you want to use. So you get delta B as negative 0.566323. So based on the duration of 3.84, and the change in yield of 15 basis points, or change in interest rates of 15 basis points, you have. Okay, one more thing. In fact, when I am referring to the denominator as the change in yield over here directly, so there will be multiple durations which we will discuss later on. Okay, we'll discuss the duration with respect to interest rates also, with respect to some zero rates also. Okay, so not only duration but DV01. So all these things will be discussed. Currently, we are interested in the proportional change in bond price with respect to proportional change in yield. But there is a similar negative relation. Of course, it will be not only with the yield but also with interest rates, spot rates. Anyways, that is not a part of this chapter today. So this is the change in the bond price. The bond value will decrease by 0.56632 $3. What is the Macaulay duration? Macaulay duration is the correct value of duration if yield is measured with continuous compounding. But if yield is measured with some other compounding frequency, then modified duration is better. Okay. Now, what is Macaulay duration? Macaulay duration is the weighted average term to maturity of the cash flows from a bond. So if these are the cash flows, let's say for a bond, it's a 3-year bond, let's say for example, this is the timeline which is given. So this is how you calculate duration. This part over here is the weight corresponding to each cash flow. Now, if you see how the weight has been calculated, in the numerator, you have the present value of that coupon or that cash flow. In the denominator, you have the whole present value of the bond. So the proportion of the money, the proportion of the total money which is received today in terms of present value is the weight of that money, is the weight of, sorry, that time point today, not the weight of that money, the weight of that time point, I should say. So this is the weight. This entire thing is the weight corresponding to this time point. Okay. Now you will say that in the beginning, I discussed that duration is the measure of sensitivity with respect to yield. And suddenly duration becomes this time, weighted average time. What is happening? Actually, both these results can be proven from each other using a slight bit of calculus, which we have done in our pre-2020 videos. So both the results are same. They just use a little bit of calculus. You'll get sensitivity from weighted average time and weighted average time from sensitivity. But that is since not in the course, so we will not discuss. But once you encounter this thought in your mind, don't worry. They both can be derived from each other. Or else you can use this formula also. Sometimes this is preferred because the value of B is divided only once. You don't need to divide by the individual present value all the time because B is a constant, right? Once you find out the value of B, it can also come out of the bracket. But again, the choice is yours. So considering the same bond, which we discussed in FMP 16 part 1. So this was the present value that we calculated, right? Remember 102.0695. Same bond is there. So in this case, N was 6 and we also calculated the yield, right? The yield we calculated as 5.2455. Now with continuous compounding, if you want to convert this yield into continuous compounding, this is the formula, right? 5.1779%. This is how you calculate the Macaulay duration. You will see these are the time points. This is the cash flow. Present value using yield as discount rate. So which yield are we using over here? Can you tell me? There are two options. See, this is the yield 5.2455% and 5.1779%. Can you tell me which one we have to use?
Continuous compounded yield.
Exactly. Since we are interested in Macaulay duration, we have to be very careful that we cannot use this yield directly. We have to use this yield. Okay. So for Macaulay duration, we will calculate the present value like this using this yield. Negative sign, of course, to discounting factor, and the yield was 5.179% approximately, right? The continuously compounded yield. So the present value of this $3 using this continuously compounded yield becomes 2.9233. Okay. Now to calculate the weight corresponding to this time point 0.5, the weight of this 0.5 or W1, you can say, although this time point is 0.5, I'm not calling it as say W0.5 all the time. Let's call it as W1 also. So W1 means first weight, second weight, third weight, like this. Okay. First time point, second time point, and but just be careful that the first time point is 0.5 years. Or else it's your choice. You can also call it as W0.5, but then you have to be careful that this is T0.5. Okay. So the weight corresponding to the first time point is 0.02684%. You know what this means, the interpretation? The interpretation is that 2.684% of your cash flows, of the total cash flows, are being received at time t equal to 0.5 years. That is why weighted average of all the times gives you the average time at which all the cash flows are received. This is the whole idea behind it. So you find out the weights corresponding to the times. You know, these mistakes you will always make. You know, many people say this. This is the weight of the first cash flow. No, this is not the weight of this 3. No, not at all. This is the weight of this 0.5. Okay, because 2.684% of your cash flows are being received at t equal to 0.5 years. So yeah, then you do W1 T1, the time into weight, you get 0.1432, this one. Similarly, you add it for all the time points. You calculate the time times weight for all the time points, and you get 2.79238 years. So it means that the average time by which all the cash flows are received of the bond is 2.79 years approximately. Okay. And you all know that for a zero coupon bond, duration is always equal to its maturity, because all the cash flows are being received at the end only. In fact, there's a separate section on that. So right now we just introduce it. But for a coupon paying bond, the duration will always be less than its maturity, because some of its cash flows are being received before maturity. That is why. So this is the Macaulay duration. So if we take an example, the previous example, again, we have to be very smart about it. We calculated the Macaulay duration as 2.79238. Now to find out the modified duration, which yield you will use? Continuously compounded yield or semi-annual compounded yield? Now you will use this yield, the first one, 5.2455. Okay. So that is what we do. And we get the modified duration as 2.721015. Okay. Now this is another term, dollar duration. It directly gives you in the form of dollars, the product of modified duration and price of the bond. It gives you the change in bond price in dollars directly. Okay. So it's simply dollar duration is nothing but modified duration multiplied by modified duration multiplied by the bond price. That's it. Now, what are the limitations of duration? It assumes a linear relationship between interest rates and bond price. That is the first problem. If suppose the convexity is higher, because you know that this is the relationship, you've all seen the diagram, right? If this curvature is higher, if the convexity is higher, then duration becomes more and more approximate. Duration provides a good approximation if you have a small and parallel shift in the interest rate term structure, but it is not good for a large and non-parallel shift in the interest rate term structure. So there is another measure which we incorporate along with duration, which is convexity, and this is the formula to incorporate both duration as well as convexity and find out the final change in the bond price. So you can take B as common as well, completely your choice. The first effect is your duration effect, this one. The second one is your convexity effect. Now I'll not go to the diagram right now, because there was a very beautiful graphical illustration that we actually did for showing how convexity effect is always positive and which side you get more pronounced effect of interest rates. There was a diagram, but that diagram itself will take 30 to 45 minutes. We'll just go to the equation, right? Just by looking at the equation, tell me, can I say that duration effect can be positive or negative? Because delta y can be positive or negative, right? And this negative sign over here is there. So negative may become positive, or negative positive may become positive. Negative, sorry. But what about convexity effect? Just by looking at the equation without the diagram, can I say that convexity effect is always positive? Because you have delta y square. This term can never be negative, correct? Convexity is positive, bond value is positive, this term is positive. So convexity effect is always positive. Duration effect can be positive or negative. So convexity is estimated in the same way, okay, as duration, weighted average, the same idea. The only difference is that the weighted average is taken off time square, not time. Okay, and modified convexity is expressed like this: convexity divided by 1 plus y divided by whole square. Okay, so let's say if these parameters are given to you, you just have to find out what will be the change in bond price. And if 160 basis points means 0.016, as I told you, divided by 10,000. So delta B is equal to this much, which is equal to this much. Okay, so if you calculate it, you will get around negative 4.95. Now, this is a slide where we just have shown the same calculation of convexity, but I highly doubt that calculation of convexity will be asked in the exam, because it will take too much time. So square of time multiplied by weight, basically, and this is the convexity, 8.13904. Okay. Now let us come to forward rates. Forward rates are the future interest rates implied by today's zero coupon interest rates. Okay. So let's say this is the timeline. Let's say you know that from 0 to T1, the interest rate is R1, and from 0 to T2, the interest rate is R2. You don't know what is the interest rate is going to be from T1 to T2, because today at time t equal to 0, you cannot predict this, right? You don't know. So there is a proper mathematical way to project it. They are implied by today's zero coupon interest rate. The implication is very simple. It simply says that whether you invest through this route or through this route or route, whatever you want to call it. So this is the route from 0 to T1 and then from T1 to T2. That is one route. Another route is directly from 0 to T. You invest say $100 or $1, whatever, $1 from 0 to T1 and then from T1 to T2, or $1 directly from 0 to T2. The final amount should be same. That is the whole logic behind forward rates. Okay. So this is what we have done. So this will be the amount at T1. Left side tells you the upper route, okay, this route, and the right side is dealing with the lower route. So from 0 to T1, this is the amount, and then from T1 to T2, this is the amount, okay, because the time period is T2 minus T1. It's very simple, right? So if you solve this, you will get this result. But again, not recommended to memorize this form. Just use this logic. It will be very, very easy to find out the forward rates. Very easy. Let's take an example. And just a quick recap, 1 basis points was 0.0% or 1 divided by 10,000. So to convert basis points to decimal, divide by 10,000 always. 3-year spot rate is given as 3%. 7-year spot rate is given as 6.5%. You need to find out F3,7. So 3,7 means the interest rate between 3 and 7. So the 4-year forward rate starting 3 years from now. As I said, it is always good to draw a timeline. Always. Especially in these kind of questions. It will become very simple. This is your timeline. So from 0 to 3, you have 3%. From 0 to 7, you have 6.5%. You need the interest rate from 3 to 7. So this time period is 4 years, right? Between 3 to 7. So that's why 4-year forward rate starting 3 years from now. So they might not give you this. They might give you this whole statement. 4-year forward rate starting 3 years from. Starting from here, 4-year forward rate. Okay. As I said, don't remember the formula. Just remember that logic. $1 invested through route 1 will give you this much amount. $1 invested through route 2 will give you this much amount. They should be equal. Solve this, you will get F directly. Okay. There is an approximation also to it. The approximation is this: R2 T2 minus R1 T1 divided by T2 minus T1. This is an approximation. Okay. Can you tell me? I mean, see, if the options are not very close, then go for the approximation in the exam. It will be quite, because this formula is easy to remember, right? Because you can see there's not much of a difference between 9.125 and 9. Yeah. But if the options are very close, 9.15, 9.17, then you have to use the proper logic over here. This one. Okay, full logic. Can you tell me this formula, although it is an approximation in the discrete case, it holds 100% true in which case? This formula holds 100% true in which case? Perfect. It holds 100% true in case of continuous compounding. Okay. So for continuous compounding, this is the formula. Now, if you just try and rearrange the components of this formula, you can write it like this. You can write the same formula as R2 plus this times this. Now you will ask me, sir, what is the need to write this easy formula into this complicated formula? What is the need of this? The need is to show the relationship between F, R2 and R1. because this expression makes your job a bit easier. It means that when R2 is greater than R1, tell me, when R2 is greater than R1, do you agree that F will be greater than R2 will be greater than R1? And can you explain why, if this is the case? See, when R2 is greater than R1, this term is positive or negative, this term? This
Positive.
term positive. And of course, these are already positive, right? Time index T1 and T2 minus T1 is also positive. T2 is greater than T1, so T2 minus T1 is also positive. This is positive, this is positive. R2 plus something positive. Greater than R2 or less than R2? R2 plus something positive. Greater than R2 or less than R2?
Greater than R2.
So can we say that when R2 is greater than R1, forward rate will be even greater than R2? And of course, it is greater than R1. Okay? Is it clear, this relationship? But what about the opposite case? When R2 is less than R1, this term will become negative, and R2 plus something negative will be less than R2. So when R1 is greater than R2, then F will be less than R2, less than R1. Okay. Whereas if R2 is greater than R1, then F will be greater than R2, greater than R1. But you can write it like this to make it more consistent, or so that you can remember it easily. R2 is less than R1, like this. So when R2 is less than R1, F is less than R2, less than R1. When R2 is greater than R1, F is greater than R2, greater than R1. Okay. And the interesting part is that it is also applicable for discrete compound, this result. Okay. So even though we have derived it from the formula of continuous compounding, it is also applicable for discrete compound. Okay, then comes the last part, I think, for today. Last or second last part. Forward rate agreement. Very tricky candidates find this. I'll just tell you the logic and how to value the forward rate agreement, not the calculations. We will not do any calculations because they take a lot of time. So forward rate agreement can be thought of as an agreement to apply a certain interest rate to a certain principal for a certain period in the future. So a lot of certains are there. We'll draw and we'll understand properly. So it is an agreement that a pre-specified fixed interest rate will be exchanged for a floating interest rate. Okay, and floating interest rate was usually LIBOR, but now it has changed. Now, normally tell me, when you go to a bank, okay, say today you go to a bank and you tell the bank that I am going to take a loan, and the bank approves and the bank gives you a loan starting from 1st of June. Okay, and the interest is quoted, say, monthly. Let's say you have to pay the interest monthly, hypothetically. Do you pay the interest in the beginning of June when the payment is given to you by the bank, when the loan amount is given to you, or the end of the month? Generally, normally what happens is, does the bank tells you that, okay, this is the interest rate, 10% per annum, compounded monthly or whatever, but you have to pay in the beginning? This never happens. You always pay interest towards the end. Okay, but if the amount of this interest is known, you can always calculate the settlement value at the beginning of the period, and that is what FRA does. In FRA, the interest is settled over here. Although it is paid, the amount is calculated first at the end, but then to calculate the present value and the interest is settled over here. Okay, so let's draw a diagram first to understand everything. Okay, so ignore this part. The animation is incorrect. They should come towards the end only. So don't look at this part right now. So let's say there is a forward rate agreement, which was agreed upon today only. So today, both of us, I and one of you, agree that we'll enter into a forward rate agreement where there is a fixed rate which will be applicable between 1 year and 1.25 years. Okay. So one of the parties will pay fixed, the other party will pay floating. Okay. Now tell me one thing. The floating interest rate can only be known once you reach at t equal to 1 year. Do you agree or not? Do you know the floating interest rate? Fixed we have already fixed. Fixed we have already agreed upon. But what will be the floating interest rate between 1 and 1.25? Do we know right now? Do we know right now? We don't know. So what is the best estimate of that interest rate?
Forward
What is
rate.
the exactly? So the best estimate of the rate which will be applicable between 1 and 1.25 years is the forward rate. So based on the forward, so RF is the forward rate, RK is the fixed rate. So I'm telling you the logic, okay? I'm not doing any calculations. So just understand the logic. So for the party which is receiving floating and paying fixed, RK is fixed, so it is going outgoing. So that's why you have a minus sign. RF is being received, so it has a positive sign. So RF minus RK multiplied by tau L. Now you will ask me that, okay, why this so easy calculation? Why not a proper interest calculation has been done? Why simply multiplied by tau times L, where L is the notional principal, tau is the time, that is 3 months. This is not fair, right? I mean, just interest being multiplied by tau and multiplied by L, this is like a calculation of simple interest. Where is present value and discount factors and all those things going? What is happening? To make your calculations easier, in fact, there is a norm in forward rate agreements that the compounding frequency of these interest rates will be quoted in the same frequency as suggested by the time period of the forward rate agreement. So it means that if the forward rate agreement lasts for only 3 months, these interest rates will automatically, they have to be quoted in quarterly compounding so that this calculation becomes easier. Is my point clear? Is it clear? Okay. So again, this forward rate agreement also, we solved a lot of examples. We took around 1.5 hours to explain the forward rate agreement concepts in the videos. But over here, we'll just explain the idea, the logic. We'll not do any calculations. If there is any part which is not clear, ask immediately. Okay. So remember that, again, I'm repeating, the compounding frequency of these interest rates will be same as the compounding frequency as suggested by the period of the forward rate. Yes, it can be asked in the exam. Absolutely. Absolutely, it can be. Now tell me one thing, if this is the payoff that you have calculated, if this is the payoff that you have already calculated, can you find out the present value of this payoff at this point? Is it possible?
Yeah,
Is it
discount
possible?
it.
Yes, yes. So you simply discount it. So can I say that you to discount it, you simply divide it by 1 plus RF multiplied by tau? As simple as that. Because RF is quarterly compounding. RF is quarterly compounding.
Here this tau will get cancelled.
There's a small mistake. Small mistake. It's a typo. This bracket will not be there. Sorry. Small mistake. This bracket will not be there. This will be simply 1 plus RF times tau. Tau is 3 months. See, if you want, I can just show you some numbers. Wait, if you're getting confused. Let's say you project that RF is, say, 8% per annum with quarterly compounding. Okay. With quarterly compounding. And hypothetically, let's assume that this amount is $100. To discount this $100 to its present value with this interest rate, what is the formula you're going to use? Are you going to use this formula? 100 divided by 1 plus 0.08 divided by 4 raised to the power 4 multiplied by 0.25. Yes or no? Do you agree on this?
Yes.
Okay. Now see why we have simply replaced it with such a simple expression. Because see, The advantage of having the same compounding frequency as suggested by this term of the forward contract means that this exponent will always become 1, always. Okay. And finally, your numerator, this denominator part will get reduced to this 100 divided by 1 plus 0.08, which is the interest rate, multiplied by 1 by 4. So don't you think it is simply 1 plus RF times tau? Yes or no now? Because this is 1. This is disappeared. So you're only left with 1 plus 0.08 by 4. So which is 1 plus 0.02. That is what is RF times tau. RF is 8%, tau is 0.25. Finished. You are still getting 0.02. Is it clear to everyone? To everyone. You are saying doubt, should it not be RK minus RF? This part you are saying RK minus RF? The discount rate? Are you talking about the discount rate? Okay. So there is a question that the discount rate, should it be? No, the discount rate will not be. This is the difference in the payoff that the two parties will offer to each other. The discount rate is still the interest rate which is applicable during this period. See, try and understand why. What is the discount rate? Discount rate is the interest rate which is applicable between that period. RK is something which we fixed earlier at t equal to 0 to determine our payoff. But if you want to determine discount any cash flow for that matter, any cash flow, forget the forward rate cash flows, forget everything. Any normal cash flow, if you want to discount, which interest rate you use? The interest rate applicable between these two times, right? Agreed or not? Will, got it? So the interest rate applicable between 1 and 1.25, the market interest rate is RF only, na? Right? So the discount rate is always RF over here, okay? So these questions, whatever doubts you have, ask immediately. Everything will be clear, don't worry. So this 1 plus RF, yeah, again, this bracket is not there. So this is 1 plus RF times tau. That's it. Okay, got it, fine. Now comes the next part. So this is the part where you might be asked to find out the settlement value of the FRA, the value at which FRA is settled at t equal to 1. What if you want to value the FRA today? You have to find out the present value of this, correct? Today you have to find out the present value of this. Okay. So how do you find out the present value of this? This is the formula.
I have one question.
Yes.
This one is the formula is like for the party paying the fixed and receiving variable.
Floating. Correct.
Floating.
Correct. And if the opposite it was the case, if you have to find out the calculations for the party paying the floating and receiving the fixed, RK minus RF it will become. The numerator will change. That's it. Okay. So if you want to find out the present value of this, we simply divide this. Okay. Let's call it as this entire thing. Let's call it as capital P. So basically we are finding out the present value of P over here. So this is nothing but P divided by 1 plus R 0, 1 raised to the power 1, which makes sense because whatever you do, you have to discount it by that rate which is applicable between this period. So between 0 and 1, which is the interest rate which is applicable? Between 0 and 1, what is the interest rate that is applicable? The spot rate. This interest rate, agreed or not? So you have to be very careful when you choose the interest rates. You have to be very, very careful which interest rate you are using, because this is a part which confuses many candidates. It is just about choosing the correct interest rates and remembering that the compounding frequency of these interest rates will match with the time period of the forward contract for sure. That is the first point. This will make your job quite easy because the denominator will become quite simple. Okay, even if you don't want to remember the formula, in fact, I would not even suggest to remember the formula. You just do the same thing. 1 plus, in the denominator, 1 plus 0.08 by 4 raised to the power 4 times 0.8. That is also okay. But you will find automatically that your job has become easier. The second thing that you need to be careful about is which interest rate to use for discounting. So for this particular period between 1 and 1.25, you use the interest rates between 1 and 1.25 for discounting. And the best projection is the forward rate. That is what we have projected. So this is RF for discounting between 1 and 1.25. But for discounting between 0 and 1 year, you will use the spot rates given between 0 and 1 year. Finished. Got it? Is it clear to everyone? So don't get bothered at all by these formulae at all. No need to remember anything. Not a single formula. That is why present value of P. That's it you have to remember. You have to find out the present value of this P in the beginning. Use the formula. Finished. No, sorry, use the logic. Don't use the formula. Simple discounting logic with the precaution, compounding frequency of interest rates and which interest rates applicable for that particular discounting period. Okay, fine. Let's continue. One more part is left. That is bootstrapping. And then one theory section is there, which we'll discuss quickly. So I think 5 to 6 more minutes now. So let's say the zero coupon interest rates are given in the table. Now, why we do bootstrapping? Can you tell me, anyone who has studied bootstrapping, what is the idea behind bootstrapping? Why do we do bootstrapping?
We have data of periods. Sorry. We have data of previous periods, and we want to calculate the current period, one of the period based on the previous data.
Okay, fine. So you want to find out, yes, okay. You can say missing prices. You can say yes, in data science also we used to find missing variables. In this case, we have to find out the zero coupon interest rates for certain maturities. Now see, there are money market instruments which have a maturity of less than equal to 1 year. They provide all the return at the end of their lives. So in a direct manner, they provide information about the zero coupon interest rates. In a direct manner, it's quite easy to calculate the zero coupon interest rates from zero coupon instruments, right? But if there are instruments which are lasting longer than 1 year, they actually make coupon payments. So then the zero coupon rates, which are not directly given in the markets implied by these instruments, they have to be calculated. That is why we have to use bootstrap. Okay, in this particular case. So we actually walk forward, we fit the zero coupon interest rates, which we have already determined. We do this progressively for longer maturity instruments. Okay, so let's say these are the interest rates which are given. So for 0.5 years, 1 year, and even for 1.5 years, let's say you have calculated that it will be 2.5%. Even this calculation you have done. Then you suppose further that there is a 2-year bond with a par value of $100, market value of 102.7, when it pays a semi-annual coupon at the rate of 4% per year. So let the 2-year zero coupon interest rate be R. So this is what you have to project. You know these zero coupon interest rate. You have to project the 2-year zero coupon interest rate, which is R. So what you do, again, the calculations are quite simple. So again, I'll reproduce this table for the next slide, and these are the calculations. So these are the cash flows: $2, $2, $2, $102. Okay, and this is R, which is missing. So use the previous interest rates: 2%, 2.3%, 2.5%, and you find out the next interest rate. That is what bootstrapping is all about. Okay. Then determining zero. Now, again, we have taken multiple examples also. There are some other examples of bootstrapping where we do it from scratch and we go on progressively. Over here, I've only shown one single step for one calculation. That's it. Okay, what is this? Anyone? What is this called? Term structure, right? This is the term structure, yes, of 0 rates. Rate curve or term structure, you can say, right? So by constructing this term structure, remember, for values to the left of 0.5, which was the minimum time period for which 0 rate was available, you keep it same exactly as the 0 rate of 0.5. And similarly, you do it for the highest point also. So if you don't have anything after 2, you keep everything constant at the same levels at 2. That's it. Then the last slide, there are several theories which about what determines the shape of the zero coupon interest rates. Please go through these in detail, revise it quickly for the exam. And is market segmentation, then expectations theory, and then liquidity preference theory. So everything we explained in the video in detail, but of course, because of lack of time, we are just telling you that these are the theories, and you need to at least have a quick overview of these theories. If it's not clear to you, then go do these theories in detail, because again, as far as the exam is concerned, in this particular chapter, the theories of term structure has been asked, as I told you about one of the questions with respect to correlation and a correlation between interest rates and underlying price in the context of forwards versus futures price. So that was featured several times, maximum times I told you in the GARP sample paper questions over the last 15 years. This is also one segment which features multiple times in the exam. Okay, candidates always say that the theories of term structure something was asked. So do this quite carefully. Okay, fine. So that's it for today's session. Thank you very much. So we'll just conclude the session and we'll inform you about the next session whenever we're going to have it. Okay, anything which you guys want to discuss? Yes, the recording will be available. It takes some time to process. Okay, so the processing will be done, I think, within 2-3 hours, and the uploading will also take some 2. So by tomorrow it will be available. Yes. You can take our mock tests. You can just message on Telegram for Midafin candidates, and in fact, yes, PDF we will definitely share. I mean, it will take some time even for quants. We are just refining it a little bit because there were some annotations which were not clear. They were very haphazardly done, very quickly done in the class. So at least those things should be clear. Otherwise, it will not be much useful. Those slides wherever I have written something which is useful. So quality control checks will go on and we will upload it. It will be helpful for revision for sure. Okay. Probably on Saturday, and it is possible that I may not be taking that Saturday session. One of the other instructors might be taking. Let's see. If I am available, I'll take. Otherwise, one of the other instructors will take. Yes. So another part of book 2, yes. So the next few chapters will be covered in book 2. Correct. I'll try my best with it. I'll try my best for sure. Okay. So mocks are already open. Thank you, Kabul. Mocks are already open. You can always message on Telegram, Midafin candidates, and they can just start the mock test as soon as possible. Anything else which we have to discuss? Any doubt? Any not academic doubt? Anything with respect to in fact, what I'll do is, irrespective of the number of classes I take after this, I'll at least have a 1-hour session with all of you where I'll discuss things related to time management, and at least not a 1 hour, 30-minute session. How to be, I mean, of course, tips and tricks, because it is possible that some things which work for me might not work for you. But based on my experience over the last many years training FRM candidates over the last 9-10 years, so whatever experience we have got, based on that, we'll try and share some of our feedback so that you can manage your time properly in the exam. Thank you, Shiva. Thank you so much. Sunday class, probably VRM, yes. After FMP, if some of the topics of FMP are left even after Saturday, then we'll cover FMP. Yeah, for foundations of risk management, we will not have a session, I think. We'll only have sessions for QTA, FMP, and VRM. I'm not very sure right now, but even if we don't have a session, what we'll try to do, we'll try to upload the videos if possible. If not, then only for 3 modules we have the crash course. Okay. Thank you. Thank you very much. Thank you. You can take long hours, never boring. Okay. Rohit, thank you very much. I'll definitely try, because see, actually, what happened last time after the class, many candidates suggested this, and we also agreed that if it is divided into two parts, it can be manageable for the candidates. I'm saying I will not have any problem. In fact, even when the last class happened, from morning to evening, there was, I mean, the involvement of participants was also quite good, and I don't think there was any drop in the energy level even towards the end, right? So that should be not a problem taking long hours, but it becomes a little bit unmanageable for many candidates. So that's why it's better to split into two parts. Okay. In fact, I personally prefer to take the session at one go, because see, it makes my time management easier, because everything, if I have to finish, it will be done and dusted. So anyways, so let's end the session, and then stay in touch on WhatsApp and Telegram. We'll be informed about the next session. Apart from that, notifications are always sent on mail. Remember that. If you're not receiving it, it means maybe it's going in spam folder or what. But for most of the candidates, 90% of the candidates, they always say that yes, they are receiving the notifications. Okay, those who are enrolled for the course, there's an automatic reminder section that we have. The automatic reminders go yes. Through the app also you'll get. And one more feature I want to tell you. So if you download the app, all these lectures, you can also download these lectures and you can view them offline, just like you have YouTube offline, right? You'll not be able to view it locally through any other app. You'll not be able to transfer it. Okay. But if you have Android, then Android, even for iOS, some candidates is working quite fine. But for some candidates, iOS app is crashing. I totally agree, and we are definitely trying to fix it as soon as possible. It will still take, I think, a month or so to fix the iOS app properly, because the problem is, see, what happens is iOS, the system is so slow. We send them an update and then they'll revert back, and then we send them a mail again. It takes a lot of time to address even small issues in iOS. Android, they're much more responsive. Google Play Store. Okay, so anyways, those who want to view this offline, because many of you are having problems, say sometimes you are traveling, so you might not have access to internet all the time. So what you can do is, whenever you have access to broadband, you can click on the download button on the app. You can use that lecture whenever you are traveling, you're commuting, where you have network issues and all. Okay. In India, at least, the good part is that we don't have any internet issues even while we are traveling. But there are many countries where this is a problem, that network is not available many a time. So please download the lectures and view them in offline mode. Yes, there is an option, Sushant. Once you have taken the mock, you can always revisit the question. There's always an option. You can do one thing: you message on Telegram this query, and it will be resolved. Okay. Okay. Thank you very much, guys. Good evening. Enjoy the remaining part of your Sunday. That's what I'll say. But keep on studying. Okay. Bye.